Cuts.
MSCI Asia Pacific down by 0.5% this morning. A lot of people asking questions about, is the Fed really done? We seem to have been on a bit of a dance there this week. S&P futures also weaker on that theme. US 10-year yields, well, they were down on Friday on the jobs report, up on Monday, down on Tuesday, up today. So you get the picture, a lot of volatility there. Iron ore futures moving higher then, Tom. And this in connection with a story, reports at least coming out in Asia around Ping An and the property sector in China. It's pushing higher commodity prices, which could be relevant for Europe.
Yeah, quite significant if that story is confirmed around potential investments in country garden, what that means for the broader real estate sector. Futures in Europe pointing lower by around 0.5% on the DAX futures. FTSE 100 futures looking to move lower by about 22 points, Anna.
OK, so the futures picture negative. What does that mean for the start of European trading? We're getting the Spanish IBEX opening in negative territory, down by 0.3%. The FTSE 100 fairly flat. We are getting more and more into earnings season. As Mark was saying at the top of the last hour, the macro things perhaps taking a back seat or maybe willing to take their lead from some of the earnings stories we've had coming through. But there are macro themes to trade around, and the Fed, of course, is central to that. We're going to hear from certain Fed officials this week, including Jerome Powell. What kind of messaging will we get around financial conditions? That's going to be crucial, it seems, for market sentiment. The FTSE then down by 0.2%, as is the FTSE MIB over in Italy. That negativity in keeping with a bit of movement into risk, into the perceived safety of the US dollar then, up 0.1% there, a bit of weakness in the pound and the euro there. We actually see quite a mixed picture on sovereign bonds then, perhaps, Tom, reflecting this increasing nervousness, I suppose, about whether we really are at the top when it comes to global interest rates. And commodities, negative, at least on some of those, but a mixed bag, really. I guess it is a day where it's going to be a lot about the earnings stories. And we've talked about the banking sector. We're going to be talking about auto suppliers a little bit later on. What do you see on sectors?
Well, the banking sector is down by 0.5%. So as a sector, not getting much relief in terms of the earnings beats that came through from Commerzbank and Credit Agricole. We talk about the yield story. The 10-year, the last time I looked, was still around that 460 level. But the modest move higher in yields in the session, maybe that's part of the factor weighing on technology. That sector currently down 0.3%. It was the leader across your sectors yesterday. Bottom of the list yesterday was energy, and the pain continues to come through there. Down 0.5%. Yes, you have some reports and indications that demand is starting to weaken in the US. We talked about the China weakness coming through, but now US seems to be a concern for the oil markets as well. Energy is a sector down 0.5%. The consumer as a sector just adding 0.1% in terms of the gains. Retail also gaining 0.2. Travel and leisure in positive territory. Financial services now down 0.8%. So it's a bit of a mixed picture across these sectors, across the benchmark. You're seeing losses so far in the session, 0.3%.
OK, let's get into some of the market themes then this morning. Sam Alstead joins us from the Markets Today blog and can take us through his thoughts this morning. Very nice to see you again, Sam. Let me talk about the wider risk appetite driven by what we're seeing in bond markets at the moment. Such volatility. I was talking about the 10-year yield. You know, it fell on Friday in connection with that jobs report, up on Monday, down on Tuesday, up today.
Yes.
It's difficult to find a really solid story in all of that noise.
Yeah, that's true. And I mean, there's a nice story on the terminal today about this kind of betting once again on this dovish pivot from the Fed, right? Which is coming mainly because bond yields went up. Almost every time that gets bet on, bond yields start to go down, and we've heard the Fed in their last couple of meetings talking about this being part of the restrictive financial conditions is that bond yields are going to go up. So that seems to have happened again in the last couple of days. A bet that there's going to be a dovish pivot, Treasury yields come down, and then maybe that bet goes away again.
Excellent.
Yeah,
I'm glad somebody managed to do justice to that story.
It's the push and pull. Yeah, thank you, Sam, for breaking that down for us. I think, what was it, Deutsche Bank pointing out that we've had 7 bets in the most recent recent cycle that we've reached pivot territory, and of course, over those 7 times, it hasn't quite come to fruition. So we'll see if this time it does. But that push and pull around the yield story is really interesting. Talk us about what is going, it's a bit of a head scratcher to some extent to look at the oil price action, given the geopolitics, and yet we're down at the lowest levels in about 3 months in terms of the prices. What are you looking at? What is the broader story around oil?
Yeah, I mean, actually, another very volatile story in the last few weeks. We actually had a couple of weeks when you had an almost carbon copy of this kind of war risk premium coming out over the course of a weekend and then building back up over the course of the week. That now seems to have all cooled off, and the focus is going back onto, in particular, the kind of demand indicators. And one of the ones that's being cited quite a bit this morning is gasoline demand in the US. So as prices go up, that demand goes down, and that now appears to be pulling there as well. And of course, we've had a lot of story this week about supplies, and so it seems as though things have moved back away from that kind of the war risk premium that we were talking about in the last few weeks, and more to the sort of fundamental demand side.
Back to the UK side of things, which I know is where the Markets Today blog spends a lot of its time contributing to the conversation. Buy now, pay later. Brits to pile on Christmas debt with buy now, pay later deals. What's the latest on this particular theme?
Yeah, so this is an interesting. So yesterday we had this retail sales data out showing that people were buying a lot of smaller things, so cutting back on bigger ticket purchases, buying a lot of smaller items. We were questioning whether, does that mean that people are retrenching completely in the run-up to Christmas and that Christmas is not going to be very good for retailers, or does it mean that they're going to just spend in a different way? And this report sort of indicates that what a lot of people may do is use buy now, pay later, may use credit cards, interest-free loans. There's actually a slightly worrying comment in that story today that a lot of people don't see buy now, pay later as debt. And so, could be that by the time you get around to January, you have quite a bad debt hangover from Christmas if that does indeed go up quite significantly.
Okay, so that is something, certainly a metric to watch as we build up to the holiday season. Sam Unstead from our Markets Today blog, thank you. You can get more, of course, from Sam, the rest of the team on the front page of the Bloomberg UK website, or by typing TLIV GO on the terminal.
Here's what we're looking out for then today. At 9:30 a.m. UK time, Bank of England Governor Andrew Bailey delivers the keynote address at an event at the Central Bank of Ireland. Half an hour later, we get euro area retail sales data for an update on the health of the European consumer. In the afternoon at 2:15 p.m. London time, that is, Fed Chair Jerome Powell will deliver opening remarks at a Fed conference. Later in the evening, the US 10-year bond auction begins, and after the US market close, Disney third quarter earnings will be released. Investors will be on the lookout for streaming numbers and the progress of talks with striking actors. A lot of themes then, from the specifics around Disney to the big Fed themes, and that'll be really the focus for markets, won't it, given what we've said this morning about a lack of sort of conviction on the macro front, waiting for some detail around the Fed.
And that pressure that seems to be coming through in terms of the yield move yesterday, which obviously was significant lower on expectations building that you are in pivot territory. And then you do have comments from the likes of Kashgari, who came on the programme, of course, with our US colleagues and said, look, the fight against inflation is not yet done. Yields are edging up again in the session today.
Yeah, really interesting to watch. And I wonder what the language means to markets at this point as well, because I was talking to Grace Peters at JP Morgan yesterday, who was saying that the Fed will continue to have in its forecasts another hike, but they don't think at JP Morgan that will actually be used, but it's useful because it creates a buffer between hiking and the market suddenly thinking, oh, when will the Fed cut? And of course the Fed...
It's a stick to reach for.
There,
or
maybe.
Or to wield. As the market's now pricing in almost 100 basis points, around 92 basis points of cuts next year versus the Fed, we should forecast maybe 50 basis point or up to 50 basis points of cuts.
Interesting to hear from the Bank of England as well today, because yesterday we heard from, or end of Monday, we heard from Hugh Pill, Chief Economist of the Bank of England, and his comments really moving the gilt market. So we'll certainly focus in on all of that. Coming up on the programme, we take a look at the biggest stocks on the move this morning, including Crédit Agricole, after the French lender reported a third quarter earnings beat on the back of strong fixed income trading. More on that shortly. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything. It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kayleigh Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special one-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything.
Welcome back. This is Markets Today. We are 10 minutes into the European trading day. European stocks, the European Stock 600 down by 0.3%. Let's do a bit of a deeper dive, though, and check in on some of the individual names on the move with Joe Easton. Joe, what are you looking at?
So we've got a mixed picture in these banking stocks this morning. Tom, ABN AMRO getting slammed over in Amsterdam. Disappointment about them not doing a share buyback seems to be driving that one lower at the moment. Meanwhile, Commerzbank is doing 600 million euros worth of buybacks and benefiting more from the rising interest rates, as we discussed earlier in stocks to watch. Credit Ag is kind of trading in line with the market, up around 0.3% in terms of those other banking stocks today. The deputy CEO was speaking earlier about a potential slowdown in some of their markets. Let's have a listen to that now.
In terms of economic outlook, what we see going forward in France and in the Eurozone, it's a slowdown. It's not a recession. So we are very cautious, of course, on the future data that is going to give more precision on the evolution of the economy. But seen from now on, what we see is a slowdown, not a recession.
So that was the Credit Ag Deputy CEO speaking there. Another stock I want to bring your attention to over in the renewable space is Vestas. Finally seeing a gain for that one, up around 6%. That's in Copenhagen. A lot of weakness in that sector recently, given the recent warnings from the likes of Ørsted. That one reading through, but a positive day for those stocks today. In terms of Continental, now that did read like a sales warning. However, as we said, they did cut their guidance only back in September. So that stock is actually ticking higher by almost 2% at the moment. Another stock outperforming, this was the second best stock on the SXXP, the Stock 600, when I looked just now, is Genmab, a drug maker, also over in Copenhagen, doing some really good numbers in some of their eye care products. That one is gaining today. And a couple of broker moves to bring you down in the bottom two here. Rolls-Royce is a new buy rating or an overweight rating over at Morgan Stanley, joining all the excitement about that one, given the rebound in engines for planes. That one doing well. And AP Moller-Maersk, after that 15% drop on Friday, JP Morgan recommends buying that one, saying that that is an opportunity to buy into that stock. So both of those shares getting a boost today. Finally, on the next board, we do have lots more earnings. This one came after the close of trading yesterday. This is DPP over in Germany. It's a real estate investor getting slammed 13%. A lot of worries about the rising interest rates, the effect on the property markets. That one is hit hard. Marks and Spencer, a bumper first half for them over in the food and also clothing, not too bad as well. Negative commentary around the second half, but that seems to be ignored at the moment. And ITV is slammed in London. They are seeing a decline in advertising revenue according to their latest statement. Finally, another drop is a hold. They've seen a slowdown in their US business, some concern around their capital allocation as well. Now, we spoke to the executive over there earlier, so let's listen to that one now.
Our philosophy is when we can deal with all the capital expenditures, also this year at 2.4 billion, by the way, and we can deal also with our dividend obligations, our strategy 40-50% payout. If there is excess opportunities, then we also serve the buyback program. This year, 23, 1 billion, and also next year, we plan for 1 billion euros buyback.
So I hold the big grocer, as I say, down almost 6% at the moment. A lot of that is coming from the US, according to analysts. A slowdown in some of those sales. That one dropping over in Amsterdam this morning.
Joe, thank you very much. Joe Easton from our equities team, taking us through some of the important earnings stories of the morning. Joining us now is Sebastian Riedler, who is head of European Equity Strategy at Bank of America Global Research. Sebastian, good morning. So many things to talk to you about this morning. I wonder if we can first focus on what you're taking away from the earnings story in Europe specifically. Tom was quoting earlier on a story by one of our colleagues that sort of contrasts the S&P 500 and what the earnings story is there, maybe recovering into the third quarter, with Europe where things seem more subdued. What is your big takeaway around Europe?
I'm really not sure that I can add much to that. I think that's the main takeaway point, that the earnings season has been weak in Europe, stronger than expected in the US, and that reflects a little bit the macro situation. PMIs are already very weak in Europe. Macro surprises were extremely negative throughout the third quarter. So you see the reflection of that in earnings, confirming once more it's the macro that drives the earnings. In the US, the macro until recently has been stronger, so you're seeing better results.
If you take the view that Europe is just ahead of the US in terms of the slowdown in growth, and that the US eventually gets there with its own recession, the European stocks then make a comeback ahead of their US counterparts. Is that where to be looking into 2024 if you do want that exposure to European equities?
Yeah, I would agree with the macro thesis. That's effectively our call, that both regions have very tight credit conditions. But in the US, you had a number of offsetting factors which have confused investors the whole year long. And that was effectively fiscal stimulus. You had a widening of the budget deficit, and companies still have very large order backlogs. And we think both of these supports are melting away. So we think the US will now join Europe in that slowdown phase. But then the conclusion, I think, is I would draw a slightly different one, because European stocks are more cyclical. They're more value-oriented. So if you now get wider risk premiums, slower growth globally, and the reversal of this recent spike in bond yields, that's not the moment at which cyclical value stocks like European stocks do well.
Okay, let me ask you about what's going on in China, because this really links in then with what's going on in Europe, as always, in the earnings stories. There's been such negative sentiments around China. One example of that, I was looking at a chart of FDI into China, and it tells a really, really negative story in the most recent period. Aside from the FDI story, it's just one illustration, and we are seeing signs of things improving with Xi and Biden meeting. Where does this leave Europe? Where does this leave the European earnings story when Europe has been talking about de-risking, not decoupling? I guess what do European businesses do in that context?
Yeah, so I think we have to distinguish the structural and the cyclical story. There clearly is a decoupling, and that means this engine of earnings growth that China has once been, it is no longer. But then the question is China going to be, on the backdrop of this structural story, is it going to be an important cyclical driver, either because you get stimulus now, or because you've got such a terrible property situation that is going to drag you down? And there we think China is just going to be standing on the sidelines, because China is the only major region globally where you didn't have aggressive monetary tightening. The main story globally is you digesting enormous increases in interest rates, but that's not coming from China, it's coming from the US. It's coming from Europe. So therefore, cyclically, we think China is less interesting at the moment. The big game really is, how do these interest rate increases now play out in the developed countries? You
are, though, positive on luxury, and you can't talk about luxury without talking about China. And I just wonder to what extent you need to discriminate within the luxury space. You see Hermes up, about 26% year to date versus LVMH up about 3%. To what extent do you need to have that lens on the luxury space as you think about the China component as well?
I think in a lot of sectors you've seen that dispersion. Luckily for me as a strategist, I hand that gladly to my stock analysts. And I would just say luxury is a very cyclical sector, but it's very sensitive to what happens in global growth momentum. It has underperformed already by 20% since July. So from our perspective, is one of the very few cyclicals that is already pricing below consensus negative global macro view, is already fully in the price. Plus, if central banks are forced to turn more dovish once the macro weakness materializes and bond yields decline, as a growth sector, it benefits tremendously once bond yields start to fade again. So here you've got a cyclical pricing, a lot of negative macro news already, and potentially benefiting from any decline in bond yields from here.
Okay, that's an interesting call then on the luxury space. Globally, in the notes ahead of our conversation, Sebastian, you've talked about investor sentiment turning more bearish, but then you've asked, if everyone is bearish, why are risk premia so low? I wonder if you could take us into your thinking there. And I guess it takes us back to where we started, on that divergence between the European earnings story and the US.
So the way our client conversations are structured at the moment, we've just completed the global marketing tour in Asia, in the US, in many European countries. And what is interesting is wherever we go, people are extremely confused by the environment they see, and it's marked by all these puzzles that they're not used to. If credit conditions are so tight, how do you get 5% GDP growth in the US? If PMIs in the US are at 48, again, how is that consistent with 5% GDP growth? And another puzzle is, if everybody's so bearish, how do we see at the credit spread that prices a default rate at rock bottom levels? And the answer is there has been, all of these puzzles ultimately have the same answer, namely you had these surprising support factors to growth that we've discussed, fiscal and order backlogs. Growth has accelerated. Whenever that happens, it compresses risk premia. Therefore, no risk is priced. But because people hadn't expected that acceleration and don't trust it will continue, they're telling a bearish narrative. But because the data until recently has been so strong, it has not been reflected in risk premia.
Well, here's another puzzle then for some of our viewers, which is why you have an underweight on European banks. We've just seen Commerzbank and Crédit Agricole coming out with strong beats. What is the rationale for being underweight that sector?
Yeah, we have a number of clients that call us and they specifically want to discuss that because they look at the sector bottom up and they say, fantastic earning restorations, valuations are attractive. For the first time in a decade, you don't have a negative interest rate environment. What is there not to like? And the answer is that banks is a fascinating sector right now because from the bottom up, it looks fantastic. But from the top down, it is one of the most macro-driven sectors. If you get wider risk premia, and they're currently at rock bottom levels, at a point at which potentially you're just walking into a sharp slowdown globally, which means wider risk premia, and they have benefited from higher bond yields. But if you get slower growth, bond yields will come down. The number one sector that underperforms when risk premia go up and bond yields go down are banks. So from the top down, any slowdown in macro from here will lead banks to underperform.
And that ties in with what we heard from Bettina Orlop, doesn't it, around the drivers of underperformance for the sector?
Yeah, maybe some underperformance in terms of that net interest income as we look to 2024, but then a bit of a turnaround in 2025, potentially. Sebastian, thank you very much indeed. Sebastian Radler, Head of European Equity Strategy at Bank of America Global Research, on the constructive view around luxury, but keeping away from European banks, at least for now. A red head across your terminal, talking of the banking space, UBS offering its first AT1 bond deal since that Credit Suisse collapse. You remember there was a lot of focus and conversation around, and angst, frankly, around the AT1s that were wiped out as a result of Credit Suisse being taken over by UBS, the way that structure was put together by the regulators and the government of Switzerland. Now you're getting UBS offering its first AT1 bond deal since of course, taking over Credit Suisse since the collapse of its once and former Swiss rival. We'll get more details, and if we do get more details, we'll bring those to you. Coming up, M&S shares soar after the British retailer and the first half profits beat estimates. More on that story next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability. And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Marks & Spencer shares then are the biggest gainer on the Stock 600 this morning. That's after the British food and clothing retailer reinstated its dividend for the first time since 2019. For more, we're joined by Bloomberg's Deirdre Hitwell, who covers the stock and the sector here at Bloomberg. Deirdre, very good to have you with us. So is M&S finally delivering then on a decades-long promised turnaround? Big news about this dividend.
I really think it is. It's as you said, it's the first time they've reinstated the dividend in 4 years. Profit is up a lot. And for once, both food and clothing and home are performing well, because as you'll know, M&S has always seemed to lag behind rivals on clothing and home, so it seems that everything is firing on all cylinders at the moment.
Yeah, the clothing is really interesting. I remember Stuart Rose, who used to be head of M&S, struggling with that, and many executives to turn around the clothing component within M&S. But people are coming back and buying it. What else is driving that strong result then?
I think food has been a big driver. Sales are up 15% in the first half, and I think this is a real sign that Stuart Matcham, the CEO's plan to try and make people do more of a weekly shop at M&S rather than just stopping in to buy a ready meal, for example, is finally bearing fruit. Plus, they've been investing a lot in lowering prices so that they're more competitive.
What about concerns about the future? Because they've said that the trading in October, I think, sort of followed recent trends, and that seems like a positive message. But are there concerns about where the story goes from here?
Yeah, their outlook statement was slightly woolly in the sense that they've said trading in October is good. They're expecting a good Christmas, but they've said they can't be certain that conditions will continue like so into 2024. So I think they've also said that profit will be weighted to the first half. So I think there's a slight warning there, but they could just be being cautious because in the past M&S has always overpromised and underdelivered, and maybe they're trying to reverse the habit of a lifetime.
Okay, Bloomberg's Deirdre Hitwell on the results coming through from M&S. That stock up 9.9%. It is the leader across the European stock space this morning. Plenty more coming up. We're going to have a conversation with the CFO of Continental as well. That company trimming its 4-year sales forecast slightly while making headway on improving returns during the third quarter. We are going to speak to the CFO of the German car parts supplier next. That stock currently gaining 3.2% across European equities, across the benchmark, down by 0.1%. US futures are essentially flat. Stay with us. This is Bloomberg.
we've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European stocks and US futures fall as investors wait to hear more from Fed officials, including Chair Jerome Powell. Oil tumbles to a 3-month low on bearish demand indicators. European banks beat across the board, with Commerzbank and Crédit Agricole rising after reporting strong numbers. Plus, treading lightly, the tire maker Continental gains after cutting its revenue outlook for the year, while making headway on improving returns. We will be speaking to the CFO of that business shortly. Tom, so we're sort of in a holding pattern, really, aren't we, in terms of the European stock moves this hour, waiting for a bit more clarity on where the Fed's thinking is right now about financial conditions.
Yeah, the renewed hand-wringing around the Fed and its next steps, but the earnings picture arguably pushing back a little bit in terms of the narrative here. And you're looking at an equity market that is now pairing some of the heavier losses at the start of the session and looks desperate to break into the green. So far, you are flat across the benchmark, but again, it's a slightly more positive within the context picture than we saw at the open. Currently at 442 on the European benchmark stock 600. The DAX is down by 11 points, almost 12 points, off just 0.1%. And here in the UK, the FTSE 100 is gaining 1/10, and you can thank M&S and Percy Pigs for that. Let's flip the screen and have a look at the sector breakdown then, because it's retail that is driving the gains with the biggest upside coming through for that sector. You're seeing as well autos gaining 0.5%, and Continental is part of that story because that stock, the last time I checked, was up close to 3%. Utilities down 0.7. Banks are off by 0.4, despite the gains coming through in the upside in terms of the earnings picture from Commerzbank and Crédit Agricole. Financial services also off by 0.7%. The insurance sector, the insurance industry, and some of the big insurers are down quite substantially in the session this morning. Travel and leisure, though, up 0.8%. And there's the picture when it comes to retail, Dale. Gains of more than 1.1%. And again, the last time I checked, M&S was up around 9.9%. Energy, a little bit of turnaround. Currently, the sector is up 0.2% after being the biggest loser across your sectors yesterday on the concerns about demand, not just out of China for oil, but also the US as well. Again, across your benchmark, losses now of just under 0.1%. Anna.
Okay, Tom, let's get to the story around Continental. You mentioned it there. The automaker supplier has trimmed its full-year revenue forecast to 41 to 43 billion euros, citing currency effects. The German tyre and car parts manufacturer says it's made headway improving returns during the third quarter. Joining us now from Hanover is Katia Garcia-Villa, who is the Chief Financial Officer, the CFO at Continental. Katia, very nice to speak to you this morning. Thank you for joining us. Let me ask you about the outlook for the business then, because you've cut your revenue outlook, but at the same time, the auto unit showing signs of improvement. The market choosing to look on the positive side here. What is the overall message about the outlook to the markets this morning?
Well, in general, good morning, Anna. I would like to say that we've now delivered as promised for the third quarter, so we are on a really good way. We've improved our automotive earnings, we've improved the free cash flow on the group level, and we've also once again demonstrated on the tire side a very good result, and for Quantitech again a very stable result. So looking at all that, we have reconfirmed our outlook for this year, which means that there will be more improvements to come on the revenue side, and on the improvement on the free cash flow.
Just to push you a little bit on that point, Katja, and good morning, because of course in an environment of higher interest rates, in an environment certainly of slower growth in Europe and still relatively persistent inflation pressures, the idea that you're upgrading the outlook in terms of the expectation around global autos will to some strike people as counterintuitive. What is it specifically that you're seeing that gives you the confidence around that outlook?
So in principle, when you look at what we have really improved in our outlook is that we said that our tires margin will be improved. So we've increased the outlook from 12 to 13%, up to 12.5 to 13.5%. What we will see during the course of the fourth quarter is a further improvement on the automotive side to come to to the guidance that we've laid out for this year, and that will come to a major extent also from increased automotive R&D reimbursements that we traditionally do have in the fourth quarter of the year. That will help us to drive performance in addition to the cost discipline that we still have to show and further operational improvements coming amongst others from more stable supply chains.
Costs in focus everywhere. More on that, no doubt, in a moment. Can I ask you about the EV business compared to the legacy internal combustion engine or ICE business, Katja? How profitable can your EV business be compared to the legacy technology?
I think what you need to understand, and then when you look at our current product portfolio, is that we do not depend on the powertrain that much. With the spin-off of Vitesco Technologies, we got rid of the majority of our powertrain-dependent business. You will need brakes in all cars, no matter if it's an ICE or a new electric vehicle business. You will need 4 tires on those cars. There will be some changes in the mixed components, but overall, to us, it's not of that high relevance anymore what kind of cars are being built. Which means
Katja,
also when you look at the development of our
frequently, though? Yeah, don't you have to replace them less frequently? The brakes, for example, on EVs.
I don't think that this is so far to be really talked about right now. What we're currently looking at, if there are some more changes necessary, for example, on the tire side, but there you also do have different input factors. You do have more traction on the vehicles. The vehicles are more heavy. On the other side, the driver drives a little different when you look especially on the long distance things. So now that we see the things coming into place, we will need to see how the replacement businesses will really happen. It's still a matter to be finally evaluated.
Okay, so that's on the shift around EVs. What about the investment around the autonomous business and the self-assisting or the assisted driving part of the business? Bloomberg's reported that maybe you're looking to divest, maybe you're looking at third parties around an investment injection. It requires a lot of capital. Profitability is a little bit lower within that space. Can you give us an update, Katja, on how you and the team are thinking about the autonomous division?
I think in principle, Tom, what we've always said is that we're currently undergoing a strategic review on the automotive side. So we're taking a deep dive look into our portfolio, into our businesses, and that we will communicate when we have taken decisions. I think that's the first thing to talk about. I think we've also communicated in the second quarter that we have had a really nice order intake from Aurora. So we will be the first ones to bring autonomous driving to US roads, starting with SOP in 2027. So you do see that we're making progress on this side of the business too, and they are really pushing it into the road and getting it on the right way.
But Katja, are you looking then for third parties to invest in that part of your business? What kind of third parties would it make sense to be talking to on that front?
And as I said, I really don't want to talk about speculations that are currently in the market. We will do the strategic review as described, and we will get back to you as soon as we've taken some decisions.
Okay, I want to get your views on China, the Chinese market. October retail sales, car retail sales rising 10.2% year on year. That line dropped earlier this morning, slightly faster than September. What is your view on how the Chinese market is shaping up as you look out to 2024?
I think it's quite early at this moment to talk about 2024 and how individual segments or regions will really finally develop. The Chinese market is the most important automotive market that is out there at the moment. We're monitoring the development quite carefully. We're looking at it. China has been a major point also of investments for us in the last years, not only in production capacities, but also in R&D capabilities and software technologies. We do have a strong order intake on the China side. So to us, we're looking at it, and we will see how also in the course of the supply chain future developments the Chinese market will develop.
Okay. But Katja, can you say at this point, are you seeing a recovery in the Chinese market?
I think there will be further developments in the Chinese market. I really don't want to speculate about the future steps for 2024 at the moment.
Can I ask you about the cost outlook, Katja, for the business? You mentioned the cost pressures earlier on, and it's something we're talking about with many executives from many different sectors. How at Continental do you keep costs under control?
Well, I think one of the topics that we have also communicated during the course of this year that we are working very much on R&D efficiency topics. So we are working a lot on our R&D efficiency programs. We are also talking about negotiating price increases with our customers to compensate for the cost inflationary headwinds that we're facing, especially on the automotive side. When you look at Continental as a whole, we're currently talking about 1.4 billion in total cost inflationary headwinds, of which the majority is with automotive, with around 1 billion. This is exactly why we're in partnership and discussions with our customers to look for compensations there.
Okay, so Katja, to be clear, when you have those conversations with your customers, you're not getting a sense yet that there is significant pushback on these increased prices. You think you can continue to raise prices and that customers in this environment will absorb that?
Well, Tom, it's not an easy business. Yeah, going to your customer and talking about price increases is not easy, and has not been in the past. You know that this is a total change of how the automotive business used to run in the past. We've been a very strong partner to the automotive industry over the past more than 150 years. We do bring the right technologies to the table and are still a strategic partner for our customers. This is also what you can see when you look at last year, for example, where we had a record order intake despite the fact that we renegotiated pricing quite heavily. Is that easy? No, it's not. But we are partners in this industry, and we will have to move together.
Okay, Katja, thank you very much indeed for your time. The stock, Continental, currently up 2.6%. Katja Garcia Villa, Chief Financial Officer at Continental. Thank you. Coming up, a look inside the Nestlé factory in Ukraine. We take a deep dive into how the war is impacting production. That is next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Earnings earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Markets Today. We are 44 minutes into our European trading day and fairly range-bound, really, on European equity markets, fairly flat. Let's put aside the markets then, directionless as they are this morning, and focus on some of the geopolitical stories that have maybe gone under the radar in recent weeks. The Israel-Hamas war has taken focus away from the conflict in Ukraine, but the fighting there still rages on, of course. Russian drones and missiles have targeted Ukrainian infrastructure in recent days. Still, multinationals, and there are plenty of them operating in Ukraine, for example, Nestlé, continuing to produce everyday staples such as chocolate wafers and mayonnaise in the country. Joining us now is our Bloomberg consumer goods reporter, Dasha Afanasieva, who can talk us through her latest reporting. She's been in Western Ukraine to see firsthand how the Nestlé sites there have found a new rhythm. Dasha, very nice to speak to you. Incredible, really, and slightly incongruous to think about operations of multinational businesses in what is, on the edge at least, of a war zone. So take us into your story and your sort of deep reporting here. How has Nestlé adapted in Ukraine to allow it to keep operating?
So a big part of it has been bomb shelters. So quite often, whenever you have an air raid siren, including in the sites in the west, the workers would go down for maybe 2 or more hours and production would have to stop. And then the issue would be is that you'd have to throw out sections of it. For example, the wafer dough just has to go because it ferments. And then Kharkiv, which is, Nestlé's got a Maggi instant noodle site there, and that's really close to the Russian border. They've had to build shelters that are overground, but that workers can get to within 10 seconds because the threat there is artillery. On top of that, there's just all these issues that you have to deal with, like sometimes it's power cuts, sometimes it's shortage of workers because people have obviously left Ukraine and they've also gone to fight. Particularly if you are a particularly skilled worker, you can be demanded by the army or by the war effort.
So that's some of the practical considerations, and it sounds like there's a kind of thicket fence worth of those for companies to work through. And in terms of condemnation, a lot of companies, of course, Western companies, very quick to condemn Russia's invasion of Ukraine. Has Nestlé taken a very strong stance, given it has this exposure to that market?
Nestlé has taken quite a strong stance. It straight away said, we're supporting our employees in Ukraine. It's sent humanitarian aid. It's voiced its concern. But as you said, has retained its sites in Russia, which is 6 factories, around 7,000 workers. So that's, that's bigger than Ukraine. And generally, Nestlé shuts down conversation about its Russian business because, it's reduced some of its non-essential items like Kit Kat, but it continues producing and it doesn't want excess attention on that fact.
Yes, I was going to ask you about how difficult it is for a business like Nestlé to walk this geopolitical line, given the scale of their business. I mean, they have a bigger business in Russia, I imagine, than in Ukraine. So that must be very difficult.
Absolutely. It's really tricky because you're kind of squeezed between both sides of people criticising Nestlé and saying it should leave. And on the other side, Nestlé saying that trying to leave is very risky business. We saw Danone had its assets in Russia seized when it was going to exit. The same with Carlsberg. So there are really no easy answers to this one.
What is the rationale? They're looking to expand in Ukraine. Of course, the economy is ravaged by that conflict, by Russia's war there. What is underpinning their apparent optimism in terms of the opportunity to expand in Ukraine?
Well, speaking to Nestlé's stance on the war, its head, South European head, said Nestlé believes in Ukraine, believes in Ukraine's victory, and that's what the investment is about. It was planned before the war, but they decided to keep going with it. And this new hub is going to produce Maggi noodles, Maggi instant noodles for European markets. So it's going to export, some of it might stay in Ukraine, but it's going to export through Poland. and it's testament to Ukraine's skilled workforce, which is obviously an issue because there's fewer of them, and also the raw materials that are largely found within the country.
Okay, Dasha, thanks so much for bringing us the story. Dasha Afanasieva there with the latest on that deep dive into Nestlé's operations, one of the big multinationals still operating, of course, in Ukraine. Let's get to some of our other top red stories on the Bloomberg terminal this morning. Uber gave a mixed picture of its business, reporting its second consecutive profitable quarter, but also slowing revenue growth. Overall, trips were up 25%, boosted by its rideshare unit. However, total revenue grew at its slowest pace in 10 quarters. Sources say Apple has paused work on next year's software updates for its devices, including the iPhone and the Mac, to deal with glitches in the code. We're told that engineers are fixing a range of bugs found in early versions rather than adding new features. The team responsible for assembling BlackRock's model portfolio is favouring the stock market's largest companies, potentially unleashing a flood of billions of dollars into tech shares. According to a strategist at the company, the portfolios are, quote, pretty overweight on mega-cap tech and growth stocks. Now, Ping An Insurance shares fell today after a report that Chinese authorities have asked it to take a controlling stake in the troubled developer Country Garden. According to reports from Reuters, China's State Council has instructed the local government of southern Guangdong province to help arrange a rescue. Ping An said in a statement the report is completely untrue. That has not stopped iron ore prices from moving on that particular report, Tom.
Yeah, we continue to watch that intriguing story. Coming up, stocks fall in Europe as investors, not great by a great deal. Wait to hear more, of course, about Fed speak or from the Fed, including Jerome Powell. We discuss that next. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome back. This is Markets Today, 53 minutes into the European trading day. You're looking at a flat European market as we look ahead to comments from central bank officials over in the US. The earnings story, though, bright when it comes to the banking sector. Across your sectors, retail is at the top of the list, thanks to M&S coming through with some strong earnings there as well. That sector gaining 1.2%. Bottom of the list, personal care and insurance. Some of the big insurers taking a bit of a hit. Currently, that sector down 0.9%. Let's talk about what's happening on the macro front then across these markets and bring in Heather Burke from our MLive team. Heather, your look at the stocks and weighing up some commentary from the likes of Morgan Stanley, Mike Wilson once again with the bearish commentary, and then HSBC suggesting that actually if the Fed was to engineer this long-promised soft landing, you could be seeing double-digit gains for global equities next year. How are you thinking about these competing narratives?
Yeah, I mean, we're seeing the stocks, these S&P 500s had like up 7 days, longest streak in a couple years. We are seeing the bets for, Fed rate cuts come in for next year. That's buoying stock and bond optimism. Earnings have largely been supportive. We're out of the earnings recession for the third quarter. A big thing I'm watching is we still see a deteriorating picture going into 4Q and 2024. We've seen sales earnings forecasts get cut. Sales have been especially disappointing. Weak demand has come up as a really recurring theme in conference calls. So you have these two competing narratives. As you said, HSBC seeing a double-digit rally, and Morgan Stanley calling for the bear market rally. I do think the two big factors are we going to see this Fed pivot? Are we done hiking? Are we going to have rate cuts in 2024? The Fed has kind of pushed back on that a bit this week. Earnings, that's a big picture too. Those are two of the things. And then the third thing also is, are we going to avoid a recession? We've seen some data slowing, but that's coming off a really high base, and the job market's still strong. Okay. So those are the three factors going into 2024.
So there's a lot for markets to think about at this point, a lot of conflicting forces perhaps. On the Fed, Tom was mentioning this story earlier, that bond traders have bet seventh time's a charm to try and predict a Fed pivot. It seems you've had a go many times, Heather, at predicting when the Fed is going to pivot, and we haven't always got it wrong to this point. Do we think we get it right this time?
I mean, it's kind of early to say. If you listen to the Fed speakers we've had this week, no. I mean, inflation, still is not near 2%. And I think, the last time we had this kind of bet was when we had the banking sector crisis in March, and then we had this huge, sharp rise in yields. That being said, this is the story that markets want to believe. We'll have inflation data next week, CPI, and a bunch of other data. And it seems that we're at the point where each data point kind of, changes the narrative. We've seen a lot of sharp back and forth. While we've retraced some of last week's huge moves, we still have that undercurrent of optimism in the markets that rate cuts are coming, whether it's realistic or not. The Deutsche Bank note says probably not.
Okay, Heather, thank you very much. We'll see if we get it right seventh time or whether we go in for an eighth then. Heather, thank you so much. Heather Burke from our Markets Live team. Remember, you can get up-to-date analysis and insight from Heather, from Mark, the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. That is it for Markets Today. You can get insights from the Markets Today blog team, of course. You can go to the Bloomberg UK website and click through to the blog from there. Also go to the TLIV Go function on the Bloomberg terminal. That will also take you through to the Markets Today blog. The Pulse is up next. They'll continue their coverage from the New Economy Forum. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Francine Lacroix is in Singapore at the New Economy Forum. Let's start with what's coming up on today's program. European banks beating across the board, with Commerce Bank and Credit Agricole both rallying. ABN AMRO, on the other hand, one of the biggest fallers on the European stock 600. Meanwhile, tire maker Continental cuts its revenue outlook for the year on currency effects while making headway on those improving returns. More from our interview with the CFO shortly. Plus, we're live at the Bloomberg New Economy Forum in Singapore. Guests this hour, including Scott Goodwin of Diameter Capital Partners, as well as Elizabeth Rossiello of AZA Finance. I want to get started by looking at the markets here because, of course, European markets are going to be mixed. A slew of earnings that you are going to see across the board. You are seeing some broad green on the screen when you look at, say, the FTSE 100, for example, but really broad weakness when you look at the DAX and the CAC 40 as well. A lot of that is going to come from the earnings story specifically. Remember, we did get, not only did we get Bayer and Adidas and Munich Re this morning, all of which, by the way, didn't have the best earnings stories to tell. So again, that's going to be weighing on the DAX and the broader industrial complex in Europe as well. So that's going to be something we're going to keep an eye on. But right now, the story you need to know, so whereas the broader continent is in the red, you are seeing some outperformance in the green right here in the UK and in Ireland as well. That is your market story. I want to toss it over to Francine Lacroix. She is standing by in Singapore at Bloomberg's New Economy Forum. Francine?
Thank you so much, Kriti. So let's maybe start off with stocks in Europe. Now, here in Singapore, we've definitely been focusing on geopolitics, some of the concerns, and what it means for cooperation amongst countries. Now, what investors want to know more is Fed officials due to speak later this week. We also heard from John Waldron of Goldman Sachs, and he was saying the still biggest concern is inflation. Then the Minneapolis Fed President Neil Kashkari, who was on Bloomberg Surveillance yesterday, saying policymakers have yet to win the fight against inflation. They will consider more tightening if needed.
There's no discussion amongst me and any of my colleagues about when we're going to start preparing to cut rates. The only thing that's been talked about at all is that at some point, when inflation is well on its way back down, if we didn't back off a little bit, then real rates would be getting tighter and tighter and tighter.
From inflation, we talk credit. Joining us now is Scott Goodwin. He's managing partner and co-founder of Diameter Capital Partners. Scott, great to speak to you. You're like the credit guy, right? The rising star in trying to figure out opportunities and concerns in the credit market. Where do you see opportunities?
Thanks for having us, Francine, or thanks for having me today. I think from an opportunity set perspective, dispersion's rising across credit markets. That's exciting. Volatility, whether it's geopolitical, or US inflation-based, is creating opportunities in different subsets of asset class. At the index level, investment grade, high yield, they look very uninteresting. But beneath the surface, there are things changing. Specifically in leveraged finance, we're finding opportunities. We talked a lot today about the decarbonization at this conference. The cost of capital for some of those solar projects in the US has gone up. So whether it's lending to the solar residuals at 20% for 750 FICO consumers, or LNG first lien debt at 10%, there are real opportunities that we're starting to find in that decarbonization space as the cost of capital is rising. I do think that other parts of the credit market, driven by what happened with post-SVB with the US banks, are becoming more interesting. They're less liquid, but regulatory capital trades, you're seeing the US banks and global banks under much more regulatory pressure, and they're looking to divest assets or put on hedges. So we've seen them come to us and others for hedges on their corporate revolver books. Investment grade revolvers, we're getting low teens for a 0 to 10 tranche, and for LevFin, high teens for 0 to 15. So that's really interesting mispriced risk in our view.
But Scott, when you look at industries, so you mentioned renewables, is there any other industry where you see opportunities at the moment?
Sure.
As frankly, I mean, inflation, interest rates probably create opportunities, but also a lot of risk.
Absolutely. I mean, telecom and healthcare, my whole career, that's what we bought when the market went down. Now they're the two industries in stress and distress for different reasons. We found a lot of opportunities in the telecom enterprise fiber space this year. We still think there's interesting opportunities there. Healthcare, we've been more mixed on. I think the policy volatility related to some of the LBOs there are leading to different outcomes than the market expected. So telecom's been an easier bet for us, and we'll stick with that.
And this is what, worldwide?
Well, more US, frankly. Okay. Europe has a telecom opportunity as well, but it's the national champions tend to trade much tighter than they maybe should based on credit metrics. So the U.S. opportunity set is a little deeper in the enterprise fiber space.
So Scott, when you look at fixed income like government bonds, I mean, what's the correlation between some of the corporates that you're looking at and actually what treasuries are doing?
It's actually been really almost too high this year. You've had a huge policy tightening, and spreads have remained reasonably benign and really correlated to rates. What that's meant, though, is dollar prices on debt. So if you bought a bond at par or 100 cents in 2020, let's say an Apple or Amazon long bond with a 2% coupon, that bond just on duration is now in the 50s or 60s. So you have a really different conversation where spreads aren't that interesting, but your enterprise value you create and your current yield on a leveraged finance or investment grade bond might be interesting. So for liability-driven investors, they can really defease part of their liability structure, especially in the long part of IG. 6-7% yields on long duration investment grade debt. That's really interesting.
Anything distressed?
Distressed, I mean, I think it's a little early. We see it coming from the levered loan market. That's where a lot of the bubble has built up along with private credit over the past few years. Those markets have doubled in size. High yield's effectively unchanged the past 6 years. So high yield is become a higher quality product with bigger companies, whereas levered loans and private credit are smaller companies, more levered, lower quality, and we see those cycles starting to build. A lot of the creditor on creditor violence you read about or write about on TV is where we'll start to see opportunities. Sectorally, again, it's telecom, it's healthcare, it's parts of the industrial food chain. One thing that I wouldn't necessarily call distressed, but comes out of some of the things we talked today about climate change, U.S. cat insurance or reinsurance opportunity this year, policy rates have doubled. So you've had a real opportunity, uncorrelated opportunity this year to put capital into there, and we hadn't done that since Sandy and Katrina. So it's not distressed, but it's certainly dislocated and uncorrelated. That's been really interesting as well.
And are you expecting more dislocation in the next 6 to 7 months? Again, it feels like we're in a juncture in terms of the cost of money, the cost of credit, and actually what rates do.
Yeah, the U.S. economy's slowing slowly. You don't have layoffs yet. I think that's what we would look for the U.S. consumer to start to have a little bit more of a struggle to get more negative on the market. But Europe's in a recession now, so there certainly are some opportunities there. And I think you'll see as political volatility and interest rate volatility combined, that will create a lot of opportunities on a forward-looking basis.
But do you think, and we started seeing it in some of the numbers for even credit consumption or actually paying back credit cards, do you see it going to actually companies defaulting?
Not in the near term. It takes time to default, and the creditor-on-creditor violence that we're seeing in the levered loan market's actually creating a longer runway for many of these companies. They're moving assets away from creditors to create more runway. You're actually seeing the same thing in European REITs. The European REITs were all funded by the ECB at 1% for 5 years with the CSPP program. Now those bonds are trading in the 40s and 50s. They have 1, 2, and 3 year maturities. we like those front-end bonds because what the REITs are doing is they're selling assets, they're moving assets away, and in some cases we're providing that capital to help them extend their runway, but that disfavors the long duration debt and turns that effectively into a long-term zombie.
Where does capital go into 2024?
The front end of the IG curve and the front end of the T-bill curve is where it's been going. You can statistically see that. I think there's a case to be moving into the intermediate part of the investment grade curve. Lev fin at an index level, not interesting. At a yield level, in parts of high yield, I think you can make the case for double Bs, 8%, 9%, low dollar price. You're probably not going to lose money making those investments.
Scott, it's amazing when you look at the growth of diameter, right, exponentially over the last couple of years. How do you compete with the big firms?
So I don't view it as a zero-sum game. Apollo buying a stake in us last year, a sub 5% stake, was part of
big deal.
Yeah, big deal, but part of staying independent. We've been approached in the past. John and I want to run the business ourselves, and our view is partner with the smartest, most nimble, largest big guy, and that helps us from a resource perspective, but it also helps us run our business the way we want. We choose alpha over beta in sizing our products, and that's something that we plan on continuing to do. I also think that when you think about the syndicated market, our scale, where it is now, we're just as relevant as many of those large players. Not in the private markets, and we'll get there eventually. Apollo's seeding our private debt business as part of that deal, and which we're starting to raise the capital around them now. But it's an exciting time in syndicated markets, and I think the private market opportunity is about to really ramp up because you start to see when the economy weakens more non-sponsor deals, and that's where we really want to focus over the next 12 to 18 months.
And so the biggest hurdles actually in those next 12 to 18 months to be sure that you grow in those businesses is what? Just raising capital?
Capital formation, yeah.
And that comes from where?
Everywhere.
But there's not a part of the world, or you're not trying to tap into.
I've got a lot of neighbors who are flying to the Middle East every week. I usually sit at my Bloomberg terminal and work. Eric got me out here this week, but we're really focused on running our business, and the capital will come if we put up returns.
Scott, thank you so much for joining us. Scott Goodwin, their managing partner and co-founder of Diameter Capital Partners. Now, we'll have plenty more, of course, from Singapore. Also, we focus on the Middle East. Israel says its troops have entered the center of Gaza's main city. Meanwhile, Saudi Arabia says normalization talks with Israel remain on the table. So more from the Middle East up next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
conflict in the Middle East is troubling, and we're obviously praying for a peaceful resolution and for the well-being of the innocent people who are suffering there. But beyond this tragic phase that we're going through, investors domestically and internationally are trying to address long-term issues and realize opportunities that are quite prevalent today and available today in the Kingdom of Saudi Arabia.
Well, that was the Saudi Investment Minister, Khalid Al-Fallah, speaking, of course, on the sidelines of the Bloomberg New Economy Forum here in Singapore. Now, that comes as Israel says its troops are now in the center of Gaza's biggest city. Let's get some analysis with Bloomberg's EMEA News Director, Roz Matheson. Roz, good to see you. So what's the latest from the region?
Well, as you were saying, we know that Israeli troops have been encircling Gaza City for days, and they're now conducting full-scale operations inside the city, pushing further into the center of what is a very highly densely populated area of North Gaza. They say, of course, that this area, this city, is really the stronghold for Hamas's forces, militant groups in the north of Gaza. But there are a lot of civilians there, obviously, also. So what we're seeing now is it move into a real ground war stage, street to street, potentially door-to-door fighting that's going to go on. Israel says that they'll be focusing on what they say are the strongholds of Hamas inside the city, but those are quite contentious also because Israel accuses Hamas of using some of the hospitals in the region, for example, as places to stage attacks on Israel, but there are a lot of civilians at those hospitals at the same time. So it's entering a much more delicate phase of the conflict on the ground, a much more careful phase, you would imagine, in terms of this conflict. But we are going to see door-to-door combat potentially as a result.
So, Roz, the Saudi investment minister also says that normalization talks with Israel are still on the table. How significant is this?
Well, it's interesting to see those comments because, of course, since the war broke out, Saudi Arabia has been sort of strongly concerned about the situation inside Gaza and the Palestinian question more broadly and warning Israel on that front. And in that environment, no talks can happen at all. There was sort of months of work towards a careful move towards normalization of ties between Israel and Saudi Arabia. Nothing can happen in this environment. And Israel says this conflict could go on for weeks, months, or potentially longer. So for now, nothing at all. But at least the comments from the Saudi minister were indicating a desire to have some kind of communication channel still open on that front. And longer term, depending on the trajectory of this conflict, and particularly the resolution of the Palestinian question, the door is still open at least to some sort of normalization trajectory. But right now, there's no progress that's going to happen on that front.
Roz, thank you so much. Roz Matheson there. And of course, we'll continue watching developments on the ground. Coming up, we also take a look at European banks in the earnings seasons with both Crédit Agricole's and Commerzbank up after earnings beat. That's next. And this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees, I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard, and if you don't give up, hopefully you find a way.
What we have really improved in our outlook is that we said that our tires margin will be improved. So we've increased the outlook from 12 to 13% up to 12.5 to 13.5%. What we will see during the course of the fourth quarter is a further improvement on the automotive side to come to our to the guidance that we've laid out for this year, and that will come to a major extent also from increased automotive R&D reimbursements that we traditionally do have in the fourth quarter of the year. That will help us to drive performance in addition to the cost discipline that we still have to show and further operational improvements coming, amongst others, from more stable supply chains.
Costs in focus everywhere. More on that, no doubt, in a moment. Can I ask you about the EV business compared to the legacy internal combustion engine or ICE business, Katja? How profitable can your EV business be compared to the legacy technology?
I think what you need to understand, and when you look at our current product portfolio, is that we do not depend on the powertrain that much. With the spin-off of Vitesco Technologies, we got rid of the majority of our powertrain-dependent business. You will need brakes in all cars, no matter if it's an ICE or a new electric vehicle business. You will need 4 tires on those cars. There will be some changes in the mix components, but overall, to us, it's not of that high relevance anymore what kind of cars are being built. Which means
Katja,
also when you look at the development of our
frequently, though? Yeah, don't you have to replace them less frequently, the brakes, for example, on EVs?
I don't think that this is so far to be really talked about right now. What we're currently looking at, if there are some more changes necessary, for example, on the tire side, but there you also do have different input factors. You do have more traction on the vehicles. The vehicles are more heavy. On the other side, the driver drives a little different when you look, especially on the long distance things. So now that we see the things coming into place, we will need to see how the replacement businesses will really happen. It's still a matter to be finally evaluated.
That was the Continental Chief Financial Officer speaking earlier this morning to Anna Edwards. Now, we also had a number of earnings. Commerzbank and Crédit Agricole shares both higher this morning. Now, the German lender lifted its earnings goals and also announced a buyback. France's Crédit Agricole beat on revenue and net income after fixed income trading revenue jumped some 26%. Now, the Chief Financial Officer shared his economic outlook for Europe after the earnings beat.
In terms of economic outlook, what we see going forward in France and in the Eurozone, it's a slowdown. It's not a recession. So we are very cautious, of course, on the future data that is going to give more precision on the evolution of the economy. But seen from now on, what we see is a slowdown, not a recession.
And speaking to us earlier, Commerzbank's CFO also discussed the impact that rates are having on net interest income.
Pass-through rates will go up, will further increase, so that will have a negative impact on the NII. Then we clearly also have our replication portfolio, so the moderate deposits, and there we expect benefits, but this benefits will really play a more important role from 25 onwards.
Bloomberg's Tom Metcalf joins us now. So, Tom, what were your takeaways from Crédit Agricole and Commerzbank?
Well, yeah, pretty positive signs. At least you should look at their share prices; they're all up. For me, I'd also bring in ABN AMRO just to show what a sort of a muddy picture it is in banking at the moment, because their shares have absolutely fallen, pretty much for the reasons the Commerzbank CFO was just outlining, is that net interest income. So for me, it's just how by market, as you go across Europe, you can have one bank shareholders still rewarding them for this interest rate boost, whereas when you move to say Holland, their ABN AMRO are getting absolutely hammered.
So, Tom, how has the wider European banks picture looked this earnings season?
Yeah, I think it's just this really mixed picture. So we're trying to think of what is the one through line for banks, and right now it's a pretty complicated picture. Every bank has almost its own story to tell. So yesterday we obviously had UBS has got a very big, very difficult integration that really drives all the shares at the moment on that side. And then you look at what the Cred Ag executive was just saying. How strong they were in trading income, and also relatively positive on the macro outlook. So just as you bounce from bank to bank, I'm afraid there's no one clear picture. The only thing I would say, being based in London, the UK banks are much further along in this cycle, and it's been pretty grim for them this earnings season.
All right, Tom, thank you so much. And of course, just minutes ago, UBS also beginning the sale of the first AT1 bond since Credit Suisse's collapse. So we'll have plenty more on that throughout the hour. Now, coming up, we'll bring you our exclusive interview with Khalid Al-Fallah, the Saudi Minister of Investment. He discussed the Israel-Hamas conflict at the margin, as well as the global economic outlook. That's coming up shortly, and this is Bloomberg.
Connection lost.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
European banks beating across the board, with Commerzbank and Crédit Agricole both rallying. ABN AMRO, one of the biggest followers on the Euro Stoxx 600. Tire maker Continental cuts its revenue outlook for the year on currency effects while making headway on improving returns. Now, more from our interview with the Chief Financial Officer. Plus, we're live here at the Bloomberg New Economy Forum in Singapore. Coming up, Elizabeth Rossiello of ASA Finance. Well, good morning, good afternoon, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Singapore. Now, geopolitics dominating the opening of the 6th annual Bloomberg New Economy Forum in Singapore. Now, days ahead of an expected meeting between President of the U.S., Joe Biden, and Chinese leader Xi Jinping, the Chinese Vice President Han Zheng has called for greater global cooperation.
China commits to advancing high-level opening up and steadily expanding institutional opening up of rules, regulations, management, and standards. We will provide more market and investment opportunities for companies from all over the world to share the dividends of China's institutional opening up. Unilateralism and protectionism lead nowhere. The issue of security cannot be overstretched. Decoupling, severing industry and supply chains, and the so-called de-risking will all only divide the global economy into many isolated islands.
On U.S.-China relations, we also heard from the Chief Investment Officer of Templeton Global Investments.
No, I think in the very short term in China, we could have a catalyst with the upcoming meeting potentially between President Biden and President Xi. With a bit of luck, that happens in San Francisco next week. And if that happens in the near term, in a positive vein, that could provide a temporary floor in China equities, improve sentiment.
And Middle East tensions, also, of course, a major theme here at the New Economy Forum. Saudi Arabia's Minister of Investment says talk towards normalization of ties with Israel remain on the table, but he says they have always been contingent on a pathway to a peaceful resolution of the Palestinian question. Now, we spoke to Khalid Al-Fallah earlier.
You know, the conflict in the Middle East is troubling, and we're obviously praying for a peaceful resolution and for the well-being of the innocent people who are suffering there. But beyond this tragic phase that we're going through, investors domestically and internationally are trying to address long-term issues and realize opportunities that are quite prevalent today and available today in the Kingdom of Saudi Arabia to address these long-term issues. So as you look at energy transition, Saudi Arabia has the formula for it. As you look at global supply chain challenges and the need for resilience, regionalization, being close to markets, having the right logistical and infrastructure capabilities, whether it's physical or digital. Saudi Arabia has the solution for it. If you're looking at capital markets with many countries going through exchange rate, interest rates, and lowest cost of capital, and then Saudi Arabia has the right formula for it. If you're looking for investors to invest with, the Saudi domestic investors are capable. And so we tick all of the boxes, and I think beyond the current situation in Europe and the Middle East, tension here in some parts of Asia, people will look around and find Saudi Arabia as the best destination to invest. It's happening now, and we believe that we will transition through the crisis, the set of crises going on now, and Saudi Arabia will continue to be a very attractive destination for investments.
Minister, do you worry that there will be a pause, actually, money coming into the region?
I don't worry about that. I think investors have seen that through multiple crises over the previous 60 years or so, that Saudi Arabia has continued to be a friendly jurisdiction for international investors, a stable jurisdiction with a very stable economic and political system that they can rely on.
Minister, talk to me a little bit about the fact that actually you're changing the accounting to look at FDI. What does that mean in terms of figures that you'll look at?
Well, we've been relying on our central bank to estimate what FDI numbers are, and they've been doing that for quite a few years, a couple of decades. Just recently, when the Ministry of Investment was created, we worked with colleagues across the Saudi government, our statistical authority, as well as the central bank, and we transitioned to the gold standard system of accounting per the IMF methodology, which is to actually measure to the last dollar from the financial statements of all registered international investors in the kingdom.
Does it help with the numbers?
In terms of FDI flows, the numbers are very, very healthy. They have positioned the kingdom. If you look at 22 and 21 data, we're actually number 10 globally. The Saudi economy today is number 17 globally, but if you in terms of FDI, both as a percentage of GDP and absolute numbers, where last year we attracted about $33 billion of inflows, and the year before that was also a very healthy number.
Khalid Al-Fallah there, Saudi Arabia's Minister of Investments. Now, these are some of the other things that we're following today. And Portugal's Prime Minister, Antonio Costa, has unexpectedly quit after revelations about possible government corruption involving lithium and hydrogen projects. Now, Costa's departure marks the end of an 8-year tenure and will likely lead to an early election. At a press conference in Lisbon, the former PM said he has a clear conscience, his clear conscience will cooperate with the investigation. Uber gave a mixed picture of its business, reporting its second consecutive profitable quarter, but also slowing revenue growth. Now, overall trips were up 25%, boosted by its rideshare unit. However, total revenue grew at the slowest pace in 10 quarters.
Well, the revenue growth slowdown is, again, purely as a result of these accounting reclassifications. If you look at the business and the bookings growth, which is really consumer demand, both on the ride side and on the delivery side, both of them accelerated. So our mobility business grew gross bookings 30% on a year-on-year basis. It was an acceleration over Q2.
Well, sources say Apple has paused work on next year's software updates for its devices, including the iPhone and Mac, to deal with glitches in the code. Now, we're told engineers are fixing a range of bugs found in earlier versions rather than adding new features. Ping Ad Insurance shares fell today, despite the company denying a report that Chinese authorities have asked it to take a controlling stake in troubled developer Country Garden. Now, according to Reuters, China's State Council has instructed the local government of southern Guangdong province to help arrange a rescue. Ping An said in a statement the report is completely untrue. Earlier, Benjamin Deng, the Ping An chief investment officer, shared his outlook for risk assets.
We've locked in higher interest rates in the past years and building up our portfolio so we can ride through the lower rate periods. And then in these periods, we should see risk assets like equities, real estate, and the private equities going up.
Well, that was Benjamin Deng there, Ping An's Group Chief Investment Officer. Coming up, we talk to Aza Finance Chief Executive Officer and Founder Elizabeth Rossiello on the challenges of expanding in frontier currency markets. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The conversations that matter, the insights you need. Welcome back. This is The Pulse. I'm Francine Lacqua here in Singapore. Now, joining us now, Elizabeth Rossiello, Chief Executive Officer of Aza Finance, a Kenya-based fintech startup providing currency trading solutions to frontier markets. Elizabeth, thank you so much for joining us. I mean, there's been a lot going on. We're just talking about it in the crypto world in the last 12 months. When you look at some of the money changing hands in this world and what Aza is actually facilitating, what's the value of it right now?
Well, what we see right now is that growth stage businesses, specifically fintech businesses that stayed the course through the fintech winter of the last year, are still trading and volumes growing. In fact, we recently said that no customer is too big for us. We're starting to see Fortune 50 companies, global corporates decide that working with a fintech is not a strange thing anymore. It's the best and most efficient way. Some of our competitors and some of our traditional incumbents are now partnering with us.
Has it been like, has been the trend just growing, or has it been pretty volatile, pretty choppy?
Well, I think a lot of the younger competition just exited the market, to be honest, or those who got Series A funding when money was loose and free weren't able to follow on. So those that remain are winner takes all mentality.
Talk to me a little bit about fundraising. Are you fundraising at the moment?
Who's never fundraising? But I mean, what we've seen is about $1.5 billion in fintech funding in the last couple of years in Africa. And there's, of course, 1.5 billion people on the African continent, so $1 for every person. But we can have a lot more to go.
What's your outlook for, in general, digital currency in Africa?
I mean, honestly, 10 years later, we still seem about the same proportion of people trading. It's not so much on a retail daily use. People aren't buying milk or paying rent in crypto, but we are seeing businesses use it to settle payments, specifically between Africa and China, which is quite interesting. A lot of factories are now taking digital currencies, mainly stablecoins, so dollar derivatives, G8 currency derivatives. I think, you know, the other kinds of coins just never gain popularity on a huge scale level. You still see the same, you know, level of adoption that you saw a couple of years ago.
But has any of the big sagas that we've all followed very closely actually changed or delayed some of the adoptions that you were expecting?
Well, I think, of course, the regulators were just, like everywhere globally, fed up with that kind of nonsense. And so I think when you saw the collapse of some of the big crypto players, regulators woke up. Same thing a couple years ago with the first crypto bust, you know? We've now survived, we're 10 years old as a company. We've survived 3 crypto winters at this point, and the regulators always come in strong afterwards. But that's why we're a hybrid business, and over 80% of our volume is fiat.
What do you become actually in 3-4 years?
We think we're going to become the largest non-bank broker on the continent. I mean, we're already doing about 300 million a month in volume, which is small for a bank, but gigantic for an African fintech. And we're seeing now tier 1 and tier 2 banks trade with us directly. So again, you know, first we saw other fintechs come to us, then corporates. Now we see financial institutions trade with us.
Elizabeth, do you think you're a takeover target? Would you like to be a takeover target?
I mean, we've had some offers. I'm a pretty picky person. I think for us, we spent 10 years building, and we know that the market is unique. We've seen a lot of South American interest, to be honest, which was a surprise. A couple of years ago, we had a lot of Asian interest come into the continent, but there's a lot of similarities between South American companies and African companies, given the diversity of the national markets, the regulatory, you know, development, et cetera. I think what we really need to see is who can understand emerging markets best.
Right. But so interest from South America because they like the technology and then replicate it also where they are?
Yeah, I think, you know, when you have a large continent with 55 markets, it's not the same as an American market, you know, where you can have one product with one gigantic market, or Korea, where it's a very high population density. When you have to go across the region, it takes a different kind of operational model. And we see Southeast Asian and South American companies kind of fit best with a roll-up strategy on the African continent.
Elizabeth, I mean, one of the questions we had is, were some of the operations actually limited by, you know, limited supply of dollar, but also some of the volatility that we've seen in emerging currencies?
I mean, you know, people always ask me this, what about the volatility, right? But I mean, fortunes have been made all over the world trading volatile financial assets in Zurich and Hong Kong and London, right? We know how to trade volatile assets. You know, back when I left school, everybody was trading, you know, credit financial assets that were volatile. You can make money and be risk avert and risk careful in these markets if you just apply the same risk strategies everywhere else. I think we go into it knowing that our markets are volatile, so our business model works for that. We make sure that at the end of the day, we have eliminated risk, we've de-risked ourselves, our balance sheet is healthy. I think that's the most important thing. But that just tells you not every fintech is fit for these markets.
So, right, so it's basically like almost, you know, you're fit for purpose, right? If you're built and you get the volatility, then your operations are not impacted.
Yeah, I always say we're born for volatility. So when COVID happened, we thrived. So did a lot of other African companies that were used to dealing with work-from-home staff during election violence or like a flood or a power outage. We had policies already for that. So, you know, it was very easy for us. We're also a tech company, so our engineering team was always remote. So, you know, these sorts of things make us more resilient. And I think when you start your market in Kenya and your third market is Nigeria, currency volatility is not something that you worry about. What you really worry about is the traditional things, partnering with the incumbent banks. I think that's the harder aspect to control.
And that's coming, or is it?
Well, it still happened after Silvergate and Silicon Valley Bank went out of business. I think it became very hard for fintechs globally, not just in emerging markets, to become banked. And I think that's still a major issue. It's almost like we went back to the drawing board.
Right.
And now we're seeing more regional banks, regional champions that weren't so technology focused or startup focused kind of come online. And if you're in the geography and they understand you, they're partnering, as opposed to having a global technology specialist that doesn't understand the regional differences.
But is that partly also regulation?
Partly regulation, partly management, partly time to understand local business models. I don't think just because you're a technology company, that means you have a certain business model. So how can a bank every technology company, right?
Yeah.
I think we need to have more specialist credit teams and more banking teams understand the startups in their region and in their sector.
Elizabeth, thank you so much for joining us.
Thanks
That was
for having
the Chief
me.
Executive Officer there of Asa Finance, Elizabeth Rossiello. Now, we'll have plenty more, of course, from Singapore here at the New Economy Forum. We also heard BOE Governor Andrew Bailey speaking at the Financial System Conference 2023 in Dublin. Now, he's speaking actually at the moment, live. He's talking about Brexit, having reduced the openness of the UK economy. Governor Andrew Bailey also talked about fragmentation being a risk to financial stability. We'll have plenty more. We'll listen in, actually, to what the governor has to say, and we'll have plenty more on some of those headlines. Coming up, geopolitics dominating so far this year's Bloomberg New Economy Forum. We wrap up today's themes and conversations next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in Singapore. So geopolitics has dominated the opening of the 6th annual Bloomberg New Economy Forum here in Singapore. Earlier today, China's vice president called for greater global cooperation. Those comments days ahead of an expected meeting between U.S. President Joe Biden and China's Xi Jinping. Now, joining us now is Jennifer Welch, Chief Geoeconomics Analyst at Bloomberg Economics. Also freshly started at Bloomberg, you come from the White House, where you're special advisor to the VP on all things Asia and China. So, Jennifer, first of all, welcome to Bloomberg. Welcome also to The Pulse. I mean, there's a lot going on, and it's very clear that geopolitics kind of undermining all of the efforts maybe for global cooperation. What do you most worry about right now?
I
think there's a couple of dark clouds already over us and a couple of dark clouds on the horizon. A lot of the conversation today has focused on the ongoing war in Ukraine, the new war in the Middle East, and then looming on the horizon, intensified U.S.-China tensions, and in particular around Taiwan, which is going to be holding its election in January. That's always been a sensitive issue in U.S.-China relations. It's coming at a moment where the U.S. is also preparing to hold an election, and China is already very much on the campaign trail. And I think all those dynamics combined presents a concerning picture for business leaders and for investors and governments trying to navigate these dynamics.
What does China want? I mean, there's also talks about them trying to build a base in the Middle East. Like, how difficult is it for us to understand what their end game actually is?
China's endgame in the Middle East, I think, is an evolving picture. We've seen Beijing try and play more of a role as a global peacemaker, and in particular in the Middle East, earlier this year brokering a deal between Iran and Saudi Arabia to normalize ties. Now, with the ongoing war, we've seen Beijing try and play more of a diplomatic role in the region, while at the same time still trying to understand the really complicated dynamics there. This is a really controversial area to step into, and I think Beijing is trying to be careful in maintaining its ties to the global south, which is really important about Palestine, while also maintaining its relations with Israel at the same time.
I mean, how is it looking at Taiwan? Again, we're also in the U.S. election year next year, so everything can change if we were have President Trump 2.0.
That's exactly right. And I think these two elections combined is going to make for a very dramatic year for those of us watching geopolitics. In terms of Taiwan, Beijing's definitely watching the election really closely. It's a crowded candidate field, but one of the candidates is someone that they regard with a lot of suspicion. Several of the others are kind of more wild cards, or in some cases, people that they know pretty well. And they all are presenting very different visions for Taiwan's relationship with Beijing. So whoever wins from that, and however Beijing and Washington respond to that election, could have major implications for that relationship.
But because we're in an election cycle, are we just going to have much more China bashing? And I've always been told, I don't know whether it was erroneously, that you have to make sure that the Chinese feel understood. It's not by putting tariffs that they feel understood.
I think there is a huge potential. I mean, we're already seeing it for China to be a major focus of conversations within the U.S. domestic policy circles, and in particular in the lead up to the election. Already it's becoming an issue on the campaign trail, and the incentive is for candidates to be as hawkish as possible. So I think that definitely introduces the potential for more friction in the relationship between now and next November, and certainly the possibility, as you noted, for a change in approaches depending on how that election goes.
Jennifer, great to have you on the program. Thank you so much for joining us today. That was Jennifer Welsh from Bloomberg Economics. Now, we're just over day one here at the Bloomberg New Economy Forum. We have lots more to come tomorrow. Don't miss our exclusive conversation with the UBS Chief Executive, Serge Armotti. That's tomorrow, Thursday at 9 a.m. London time. We also have Citadel's Ken Griffith, and here joining will be also Hillary Clinton. It'll be interesting to get her thoughts on the Middle East, Israel, and Gaza. Up next, to Bloomberg Brief, Danny Berger in London, Manus Cranny in New York, and this is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
The markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special 1-hour episode of Bloomberg Crypto. Bloomberg, context changes everything.
Good morning from our world headquarters in New York. I'm Manus Granny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The S&P 500 posts the longest daily winning streak in 2 years, but the futures fall this morning. Investors await to hear more from the Fed Chair Jerome Powell. Democrats win majorities in Virginia's 2 legislative chambers. The party also succeeds in Kentucky, Ohio, Pennsylvania. That's a boost for President Biden and a sign the Democrats' messaging is resonating with the voters. And geopolitics dominate discussions at the Bloomberg New Economy Forum in Singapore. Saudi Arabia's investment minister says talks aimed at normalization of diplomatic ties with Israel will continue.
That was on the table, it remains on the table, and obviously the setback over the last month has brought that, has clarified why was Saudi Arabia so adamant that resolution of the Palestinian conflict has to be part of a broader normalization in the Middle East.
Meanwhile, oil tumbles to a 3-month low. Bearish demand indicators grow from the U.S. and beyond. To understand the shift in sentiment, take a look at that. The longest winning streak since November 2021. This is on the S&P 500. This relationship is built on a very unreliable boyfriend. The stock market is absolutely banking on its relationship with the boyfriend that is the bond market. The bond market is to reprice. That repricing in lower yields gives a real momentum if you're a bull. Now, we dissipates ever so slightly this morning. SPOOs were up for 7 days in a row. As I say, the longest winning streak since 2021. NASDAQ had the longest winning streak in 2 years. Microsoft made it to a record high. I just checked it out. Up for 8 days in a row for Microsoft. You're up almost 10% on that stock. It gives it ever such a slight amount back this morning. But you can see this groundswell of the narrative in the equity market. HSBC say if you get a soft landing, and it's a big if, because we're going to hear from Hoisington, natural bond bull, but Mr. Lacey at Hoisington says it's going to be a pretty torturous 2024. If there's a soft landing, you get a 10% rally in global stocks. I put the DAX in really more so to sort of reflect down by 0.4%, but to give me the opportunity to tell you that Commerzbank is giving you a share buyback. And this is music to the bank stock ears as the KBW index here, and we'll talk about that in a moment, has had a trashing. So Commerzbank up 2%, 600 million euros of a buyback. Good morning, Ms. Berger.
Good morning, Mr. Cranny. Look, yesterday, it's hard to argue that the most important move, the biggest move, was not oil. It had a massive move, down more than 4%, after a U.S. government agency, the EIA, said that they are forecasting American demand for gasoline to fall to a 20-year low. Can you imagine that? Americans driving less. As an American myself, I have a hard time imagining that. Either way, New York crude falls to a 3-month low. It holds to those lows this morning. Sterling also down for a third consecutive day. Kicking it off this week was Hugh Hill late Monday, sanctifying more or less the market's idea that there are rate cuts to come next year. So a third day of losses, a cumulative 1% weaker on sterling versus the dollar so far in the past 3 days. Meanwhile, the 10-year yield, this thing continues to ping pong around, up 7 basis points one day, down 7 basis points the next. Today, we're up by just 1 basis point. JP Morgan says that if we continue to trade in this tight range, then CTAs are going to buy $92 billion worth of U.S. Treasury futures. So that's a lot of firepower that might come in. And a lot of it might be unwinding what we saw over the past month. That is what Waller yesterday called an earthquake menace. But basically, we're at our 7th run of an attempt of a dovish pivot. This is according to Deutsche Bank Henry Allen over there, who writes that, yes, you might be making another run at this, but historically, Manus, the runs haven't been successful. He writes that the problem is that an expectation of a pivot can actually make one less likely since it eases financial conditions. The central bank can then feel, Manus, the need to tighten again in order to bring down inflation.
Yeah, well, the risk is going into 2024 is that you have something more pronounced. There's the quote that you were just reading. Expectations of a pivot can be the very unseating. 7 times. What is it? Fool me once, shame on me. Fool me twice, shame on you. But fool me 7 times, and the bond market has got a whole other dance to play. We'll hear more from Lacey, Professor Lacey from Hoisington a little bit later on. I mean, he is a natural bond bull, but he wants to be long 18 years in duration, and he thinks not only are they going to have to cut, it's going to be a pretty tough run. Danny, let's reset because we're waiting for Powell's remarks today. That is the big event. But the Bank of England Governor, Andrew Bailey, spoke just a little bit earlier. Let's take a listen.
It can sometimes be challenging, as we've seen in recent years, when the economy is exposed to very big external shocks. And we've been experiencing, and sadly continue to do so, some very big ones of late. We have to recognize that today we live in a world economy which is experiencing fragmentation. And that is at risk of further such pressure.
So more risks at play for the global economy and the UK. Neil Wilson is the co-CEO and the co-CIO of EJF Capital. Neil, let's start with where the market is at the moment. 75 basis points of cuts in the UK for next year, 100 basis points of cuts here in the United States of America. We'll get to Europe in a moment. What I want to understand is the market is baying for cuts. Is that a personification of soft landing, 75 in the UK and 100 basis points in the United States, or something more malevolent? Good morning.
Good morning, Manus, and thank you very much for having me on today. No, I think the stock market is essentially a hope machine. I think they would love to have a soft landing. I do think that the risk in the U.S. is actually to the upside of a rate increase. The data, has a little bit of cognitive dissonance. You have some data that's saying, we're going to have a soft landing, and some data that's saying there is a risk that there's going to be a rate rise. I don't think there's that risk at all. We'll get to that maybe in a bit here in the ECB or the UK. But I do think that's where the risk is, the potential rate increase. I think it's a mistake if the Fed does do that. We see it very granularly at the bank level. The senior loan officer data is telling you that credit constriction has been very, very, very severe. So I don't think they need to raise rates, but that's where your risk would be from an outsized basis.
So if the stock market right now is a hope machine, game it out for me. What happens when hope meets reality?
Well, I think what will happen is what we're seeing it happen over the last couple of weeks, right? Or last week, you've seen the stock market bid up on the expectation that we're going to have 100 basis points next year, beginning sometime second quarter, June or so. I think what you'll hear from Powell today, Jay Powell, is going to be something more restrictive in terms of higher for longer. And I think they will be higher for longer. And so I do think there'll be a little bit of volatility. We just went through earnings season. Low volatility happens after that. But after today and after December meeting, I think you could expect some real volatility, and there is risk to the downside.
Waller said that we've had an earthquake, the 100 basis point move in the bond market. I mean, we've had multiple earthquakes, respectfully. We've gone from 0% to 500 basis points in just over a year. I mean, I call that more than an earthquake. And yet, it's only now that the slews is beginning to show a little bit of fragility. I mean, there's what Waller says. Since the end of July, this has gone one way, almost a full percentage point in central bank terms to financial markets. It's an earthquake. But that earthquake has not had the spillover that we all thought. The central bank is banking on that tightening of yields. Does Powell need to re-grasp the narrative over the next couple of days about his intention to keep things tight?
I think he will. That's what I was just saying a moment ago, Manus. I really do think that the job boning, which is part of the Fed toolkit, we're going to be higher for longer. We're still going to evaluate the need to raise rates. And I think by doing that, they're basically helping themselves by having the long end, the 10-year go higher in terms of yields, and that's doing some of the Fed's work for it, so it doesn't actually have to raise rates, although, again, like I said, I think there is a risk that they might do that. The market a few weeks ago had it at 20-25%. Now it's at 10%. But I do think there's a risk, and I think that's why you're seeing futures today some trepidation a bit, from the market.
So, Neil, you're a Virginia guy. I'm a Virginia girl. Overnight, we learned that Virginia Dems swept both state chambers. I mean, it just kind of shows us this propensity, even with Biden's bad polling, for American politics to surprise us. And we're going to get a lot of that next year. How do you want to gear up a portfolio to prepare for the volatility that is an election year in America?
Well, I think Virginia is very telling, as you know, being a Virginian, that it's a purple state. Red being Republican, blue Democrat, so purple by definition is kind of a telltale swing state. I think these elections with a very popular governor going Democrat is very telling. And so in terms of your portfolio, what I would tell you is I think it bodes poorly for the GOP in the coming elections. Even with Biden's, inherent weaknesses. And so I think the rollback of the 2022 Inflation Reduction Act, again, poor name, but very strong piece of legislation to support the renewables market. I think that the rollback of that and some concerns you've seen about that will not happen. The other thing people don't realize about the Inflation Reduction Act is that the renewable businesses, a lot of those, that manufacturing of pulling jobs back to America, guess where it happens? It happens in the Midwest, Ohio, Michigan, Wisconsin, Pennsylvania, Illinois, and those are basically the swing states. And so are Republicans really going to be pulling back the Inflation Reduction Act when all those jobs are going to be kind of coming on shore with the government support? Probably not.
Yeah.
Just want to finish off with 1 or 2 points on risk. You mentioned banks at the start of the conversation. The KBW is something that you focus on, and it's had a fairly tortured year. What is the risk going into 2024? There is the KBW, I think is down. 24 banks trading at a 30-year low. How much more risk is there? I mean, we've got massive moves in the bond market. Some people say that's where the hidden risk actually lies. We're going to talk more about that later in the show. Give us your view on banks and the risk there. The big get bigger and the small get squashed?
I think that's very well put. I think, except for that, I think there is an investment thesis for the small banks. So again, you have to buy for. America's got 3 banking systems: the large money center banks. I think the Basel III endgame hurts those. I think you're hearing Jamie Dimon and others kind of pointing that out. They're going to have to increase equity capital levels. That's going to reduce their return on tangible common equity returns. That would be not the area to focus on. The regional banks are the ones that were causing the crisis issues in March. But really where to focus from an investment thesis standpoint, we're actually very bullish at this level with the banks under $100 billion in assets, the small banks, the small banks below the regional level. Why? Because some of them are trading at 50% of book. And they're baking in, very, very high losses from a historic modeling perspective, yet the experience is not showing that, and the credit their underwriting levels were incredibly strong, have been incredibly strong since the great financial crisis. So that's where we think the smart money would be, is on the equity side of the small banks.
All right, Neil, we're going to have to end it there. Thank you so much for stopping by on your trip to London. Say hi to Virginia for me. Neil Wilson there of EJF Capital. All right, let's get to some other stories that are trending on the terminal this morning. Higher base salaries, more paid time off, gym discounts. Private equity is doing it all to retain talent as the industry weathers a prolonged slump in deals. A report by Preqin shows that buyout firms have become more selective in their hiring and are more focused on keeping their staff happy. More mid and junior level workers got a big pay rise this year.
EV news now, Danny. Rivian is ending its exclusivity agreement with Amazon for access to its electric vans. Other fleet operators will now be able to negotiate deals for those vehicles. Rivian is also raising its forecast for overall production this year. Meanwhile, EV rival Lucid is cutting its full-year production forecast.
Bloomberg has learned that Chinese President Xi Jinping is set to attend a dinner with top U.S. executives when he visits San Francisco next week for a summit. China's vice president talked up the importance of improving ties with the U.S. earlier at the Bloomberg New Economy Forum.
More recently, as agreed by the two sides, China and the United States have had more important high-level interactions. These interactions have sent out positive signals and raised the expectations of the international community on the improvement of China-US relations.
And stay with Bloomberg for the New Economy Forum in Singapore. We'll hear from the UBS CEO, Sergio Motti, John Kerry and Citadel's Ken Griffin among the conversations. Danny.
But first up on this show, Israel says its troops have entered Gaza's main city, with Netanyahu standing firm that a ceasefire is still not an option. We have the latest next on Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
The conflict in the Middle East is troubling, and we're obviously praying for a peaceful resolution and for the well-being of the innocent people who are suffering there. But beyond this tragic phase that we're going through, investors domestically and internationally are trying to address long-term issues and realize opportunities that are quite prevalent today and available today in the Kingdom of Saudi Arabia.
Saudi Arabia's investment minister Khalid Al-Faleh, they're speaking on the sidelines of Bloomberg's new economy forum in Singapore. Now, at the same time, G7 foreign ministers meeting in Tokyo agreed on the need for humanitarian pauses in Israel's war with Hamas, while Prime Minister Benjamin Netanyahu reiterated there'd be no ceasefire until the hostages taken during Hamas's October 7th attack are freed. Bloomberg's Roz Matheson joins us now. Roz, a lot of what's happening on the ground has concentrated on IDF soldiers in Gaza City. What is the latest there?
Well, we know now that Israeli soldiers who've been encircling Gaza City for some days are pushing further and further into the center of the city. They say they're going right to the heart of that city. It's a high-density population area for Gazans in general. Israel says that Hamas uses the city as its stronghold for some of the attacks it's been doing into Israel. And of course, some of those sites are a bit contentious. They include things like hospitals where there are civilians also gathered. And so what we're seeing is sort of this further careful push into Gaza City itself. But what we're going to now see is an increase really in that ground combat, door to door, street to street, with some of those very delicate sites that I mentioned. But Israel is saying they're determined to keep going because their overarching goal, as we know, is to defang Hamas to the point it can never again attack Israel in the way it did on October 7th. But it comes at a very delicate moment inside Gaza City itself. We know the humanitarian situation there is very dire for ordinary people who are still trapped there. They are at those sites, including the hospitals. So it's all very delicate, and the Israeli soldiers need to proceed very carefully as a result.
So we're at the New Economy Forum, Roz. As you know, we've been hearing from various voices, but the Saudi Arabia investment minister is saying that normalization talks with Israel, they're still on the table. So what does that mean for the region? I mean, he does caveat it, it's a process of discussion. This is Khalid Al-Faleh, isn't it?
Well, that's right. And the comments were very cautious, of course, saying again that Saudi Arabia cannot do anything further when it comes to normalization of ties with Israel until what he says the Palestinian question is resolved. And it could remain unresolved for a very, very long time. Nonetheless, this conflict could go on for a very long time. And while that's happening, there's just no prospect of direct talks again between Saudi Arabia and Israel on normalization. That's very much off the table, at least for the short term. But the comments were interesting because they suggested, still that desire in the longer term to keep the door open to dialogue on that. There was a lot of careful work that had gone on, so at least not shutting the door entirely.
And Roz, the issue of Israel and funding for Israel has obviously been very central in American politics. But we've had local elections, and on the agenda, the issues that voters care about are still things like abortion, for example. The Virginia results, to be specific, Roz, what did they show us, and what did they tell us about next year's election year?
Well, it's quite interesting because Democrats, again, seemingly confounded the rule book, which is normally in midterm stuff. Voters go the other way to the party that's in power in the White House. So you had first of all midterm elections, and now we've had state elections in several places. You mentioned Virginia, but also Ohio, Kentucky, and so on. And we saw real strong swings there towards the Democrats. So that's a big boost for Joe Biden, obviously heading into the 2024 election campaign, but also for some of his agenda, because we saw voters really rebuff Republicans in Virginia in particular, where the governor, Glenn Youngkin, has taken a very conservative stance on abortion. So you saw when it came to social issues and abortion that voters are still very much supporting the Democrats on that front. How that translates federally in over a year from now is a bit difficult to say, because most voters, in the end of the day, vote on economic matters, bread and butter issues. But it was intriguing to see the level of support for the Democrats in this, particularly in Virginia, and that's got to give the Democrats in Washington some reason to celebrate today.
Roz, thank you very much. Roz Matheson there with the very latest on the political stories around the world. On Bloomberg from New York and London, good morning.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose side.
Bloomberg. Context changes everything.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees, I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard, and if you don't give up, hopefully you find a way.
Welcome back to Bloomberg Brief. Manis, overnight, an interesting headline. Nintendo, which of course made a Super Mario Brothers movie that I guess did pretty well, said that they're going to make a Legends of Zelda movie. Manis, I was going to ask you if you've ever played this, but I mean, I would be absolutely shocked if you've ever played Legends of Zelda.
No, but you know what? I have worked with other producers who have played a lot of video games. But I think the whole idea here is really it's sort of bring them in. They're going to make movies pretty much every year. I mean, what they found is that when they produce the movie, they snag a new audience, a broader audience. I mean, I think that the Mario movie spurred an interest in playing games. They sold 4.3 million units in 2 weeks when they launched another game. The closest thing I got to video games, we go back in time now, Danny, it was like table tennis. It was bing, bing. Actually, battleships.
No,
we evolved to
Atari
battleships.
Atari Pong. We grew up with very different video games, Manis. I did play Zelda, have fond memories of it. Would I see a movie of it? I'll leave that for you to decide. It's probably not. Anyway, coming up, we'll talk to you.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Brief. I'm Manus Graney in New York.
And I'm Danny Berger in London. Here's what you need to know. The S&P 500 posts its longest daily winning streak in 2 years. Futures fall this morning, though, as investors wait to hear more from Chair Jerome Powell. Democrats win majorities in Virginia's 2 legislative chambers. The party also succeeds in Kentucky, Ohio, and Pennsylvania. It's a boost for President Biden and a sign the Democrats' messaging is resonating with voters. And geopolitics dominates discussions at the Bloomberg New Economy Forum in Singapore. Saudi Arabia's investment minister says talks aimed at a normalization of ties with Israel continue. Now, amid all of that, oil cratering yesterday more than 4%, down almost another 1% this morning. The EIA, the U.S. government agency for energy, said that U.S. demand for gasoline, they are forecasting it will drop to a 20-year low. So rather than the supply cuts, it's that demand issue that these markets are focusing on. Over in the UK, the issue that we're focusing on is still those comments from Hugh Pill earlier in the week, seeming to sanctify the idea that the UK will have a rate cut next year. Sterling tumbles for a third consecutive day, down 1% so far this week. Meanwhile, U.S. 10-year yields, they are up another basis point this morning after falling yesterday, after rising the day before, after last week's rally. All of that coming before, Manus, what Waller described as an earthquake in the bond market.
Yep, that 100 basis points. But if you look at the stock markets this morning, giving ever such a little bit back, that longest winning streak since 2021. We're living in a hope machine. That's according to EGS, our guest at 5 a.m. They managed more than $3.3 billion. Stocks are down by an eighth of 1%. Is it a hope machine or just relying on a very unreliable boyfriend, which is the bond market? And that bond market has gone for the 7th time in a row, betting on a pivot from the Fed, which is perhaps a folly. There's a cognitive dissonance in these markets, according to EGS. But we are giving a little bit back this morning. So this is more a question of really where we go next from the Fed. We'll hear from Powell today. Will he grip a hold of that higher for longer again and perhaps re-grasp some of the work that the bond market has undone? You've got HSBC out with a soft landing scenario for 2024. That'll give global stocks a ramp up of 10%. Microsoft at the bottom of your screen is coming up. That stock is up for 8 days in a row, up 10%. You want to be long of big tech. DAX is down by 0.4%, accelerating ever so slightly on the downside as you have Commerzbank coming out with a share buyback of 600 million euros from Commerzbank. The stock down by 3% just at this juncture. So again, there's a little bit of nervousness that has dipped in the past 30 minutes since we've been talking. Danny.
I still really like that line that the U.S. stock market is a hope machine. I mean, I guess it always is, right?
It's
because
a Bon Jovi.
You're placing bets on what you... Yeah. It is a Bon Jovi, a very strange and perhaps the geekiest remix of all time. But again, Neil Wilson told us he thinks that a credit crunch is coming. So what happens when hope meets reality?
Well, when hope means reality, there's usually a little bit of an injury. That's what's happened in my life. But I'll leave you with that thought. I'll just hold on. I'm living on a prayer, living on a dream. I'm all the way in on Bon Jovi this morning. Good morning.
Good morning, man. It's got to grasp onto something in these dark times. All right, let's shift gears a little bit and talk about hedge funds and regulators, because U.S. regulators and the Fed, BIS, you name it, they've been talking about what they call the dangers posed by the so-called basis trade. So it's a strategy, it's popular with hedge funds. The idea of it is it seeks to profit from small mismatches in pricing between Treasury futures and the underlying cash bonds. We heard from Fed Governor Lisa Cook. She spoke about what she sees as the risks on Monday.
Because the basis trade is often highly leveraged, a funding shock or heightened volatility in Treasury markets could force hedge funds to abruptly unwind their positions at potentially distressed prices.
Joining us now is Brian Corbett, President and CEO of the Managed Funds Association. The MFA represents more than 100 hedge funds that collectively manage over $2 trillion. Brian himself was also a senior executive at Carlyle and worked at the White House and Treasury Department over President George W. Bush. Brian, so great to have you on.
Thank you.
I know you've gotten a lot of this, questions about the basis trade. I mean, it feels relentless. Different regulators, Fed officials talking about it. Gary Gensler was talking about it yesterday. The BIS has laid it out thusly that it's about $600 billion of net short positions in the Treasury markets by hedge funds. So if they all run out the door, it will be a systematic event. Is that a real risk?
So certainly there's been a lot of attention on the basis trades, but it's important to remember the role that this trade plays in the market. There are a lot of long-term investors like pension funds who need the exposure to the futures product. And hedge funds through the basis trade provide that exposure. It's a benefit to the market in terms of providing liquidity. It helps to reduce yields. So there are a lot of positives that the trade provides to the market, but regulators are focused on it, and we believe that through their existing authorities, they do have the ability to regulate the banks and the bank counterparties. So if the regulators see a situation developing in the markets, they can work with the banks and their counterparties to require more collateral or change financing terms. The Fed recently said in their own report that the risks associated with the basis trade have likely been mitigated by the fact that banks, dealers are starting to already tighten financing arrangements with their hedge fund counterparties. What we're worried about is more of a knee-jerk reaction that actually undermines liquidity in the Treasury markets.
And it's because Ken Griffin said something similar. It should be the concentration on banks, the counterparties, not necessarily the hedge funds. So in that world, let's say this does pass and there is more scrutiny and some of the basis trade fades away, because we've already seen the shift in the bond market. We have QT, liquidity has been an issue. What does that world look like? How bad does Treasury market liquidity get without this type of hedge fund leverage in the system?
Well, you've certainly seen a change in the types of buyers in the Treasury markets as central banks and foreign buyers have pulled back. Many hedge funds have stepped into that void. But we think there's ways that you can modernize the Treasury market. We think we can provide more information on buyers and sellers. We think there's a way to enhance central clearing. But there are proposals out there, particularly at the SEC, that we worry will undermine liquidity and actually cause buyers to pull out.
Yeah, because I want to get a handle on just how bad that looks.
Yeah, so there's a proposal that the SEC has called the dealer rule, and it would require investment advisors who are just buying and selling treasuries as part of their investment strategy to register as broker-dealers. That additional regulation will cause those market participants to pull out. So at the very time that we need more buyers and sellers, the SEC is pushing a regulation that will cause buyers to pull out. It will reduce liquidity, and that will affect yields, ultimately having a knock-on effect on the interest rates that consumers pay for a lot of lending products.
Brian, good morning. It's Menace in New York. Just going back to sort of the moments in time when there are great existential angst in markets, mortgage-backed securities, not knowing who the counterparties were. Take your mind back to those pretty tough days of when we just did not know enough about our counterparties, we did not know enough about their collateral, and we did not know enough about the depth on them. Is Ken Griffin right in that the regulator should be focused on the banks and the leverage that they provide to the hedge funds, and perhaps not the hedge funds? I mean, he's sort of taken a dig, but does he have a point? Because that is where you begin then to understand the scale of let's say, risk in the market.
Well, certainly the bank supervisors have the authority over the banks today to require changes in financing arrangements, to require more collateral. So that's where the relationship exists today. And many people refer back to March 2020 when there was a sell-off during the beginning of the pandemic. And many regulators refer to that as sort of a cause for greater concern today about the basis trade. But remember back then, we were dealing with a historical, unprecedented event where all asset classes sold off. It wasn't just treasuries. And when you look at what happened in that treasury sell-off, foreign central banks sold about $400 billion. Mutual funds sold about $200 billion. Hedge funds sold $35 billion. So it's a much smaller percentage number, and even the Fed's own after-action study indicated that hedge funds were not a primary driver of the sell-off in 2020. So I think that overhang from a few years ago continues to color the dialogue a bit.
And not unrelated to this is regulators finalizing moves that would essentially say it's not just banks that we recognize as systematic financial institutions. It's non-banks, it's hedge funds, it's private equity. I know this is something you've also pushed back against, but the reality is that a lot of debt that used to be on bank balance sheets is now in the hands of others. Isn't there some degree which you say that's rational? We want to know where the debt is in the world. We want to know where the pressure points are. We have to look at other institutions.
Yes, there's no doubt following Dodd-Frank that policymakers made a decision to push some of the risk-taking activity off of bank balance sheets, and it's moved to the private markets. The private markets have grown both in terms of equity investments as well as private credit, but we still think that the relationship between an alternative investment fund and its investor is very different than the relationship between a bank and a depositor. Alternative investment funds are structured with investors who have a risk appetite and the money is locked up. Whereas with a bank, it's a depositor, government stand behind it as a backstop, and also those deposits can be pulled in a day. There's daily liquidity. So very different products, and we see the growth, particularly in private credit, as a good thing, helping to provide a lot of the lending and capital that small and medium-sized businesses need to continue to grow.
You can join the roll call of private credit that have come on the Bloomberg brief since the launch. It's like an evangelist movement in terms of diversification in your portfolio. We've had a few. Just on the slightly broader narrative, we're going into the third year of brutal bond losses. It's been a fairly volatile year. In your world, in the hedge fund world, do you think you're going to see massive or big consolidation? Do you think that that's the way forward for your industry next year? What happens next going forward?
It's a very good question in that you're not only dealing with a challenging market dynamic, but you're also seeing a regulatory environment that is changing significantly. The SEC's proposed over 20 rules targeting alternative asset managers, focusing on their book, what they report, on their operations, as well as on their relationship with their allocators and how they negotiate investments. All of those rules have a cost. They are going to squeeze smaller managers. They're going to deter new fund launches. And ultimately, the SEC could be facilitating a consolidation in the industry over time just because of the regulatory burden that they're crushing the industry with.
Yes, I mean, the burden of regulation, is the death of many new products and innovation. For me, we're going to close off with this. I've just come back from 6 years in the Middle East, and I leave when every hedge fund in the world has decided to relocate there. It's quite ironic. But I'm just curious from a global perspective as you see it. What is your first take on this massive movement? Some of the biggest hedge funds in the world are now in Abu Dhabi and in Dubai. What's the consequence of that? What's the impact of that on liquidity?
Markets are competitive. Allocators around the world are looking to find the best investors to back. And managers are going to move to environments where they have beneficial operating environments and they find competitive regulatory regimes. And certain jurisdictions are increasingly less competitive. And unfortunately, the U.S., under Chair Gensler, is moving in that direction. And that's one of the reasons why we and several other trade associations have sued the SEC on a recent rule to try and stop them from further damaging our markets and making them less competitive globally.
The fee disclosure one, right?
Correct.
Is there anything else in front of the SEC pending that you might choose to litigate?
Well, certainly the private funds rule is the one we've litigated on. We're going to look at all the final rules. We continue to work with the SEC staff to provide feedback and comment as they go through the rulemaking process. Litigation is the last resort. The last thing we want to do is be suing the regulator, but there are several rules, including the dealer proposal I mentioned around requiring entities to register as broker-dealers that could potentially be a target for litigation depending on the final rule.
Okay, Brian, thank you very much for coming to see us. Let us know the next time you got a piece of chunky litigation, come and speak to Danny and myself. We're always there for a news headline. Brian Corbett, Managed Funds Association, our guest this morning on all things hedge fund. Coming up, an exclusive interview with the legendary economist Lacey Hunt of Hoisington Investment Management. He says the bond rally is just getting started. Well, naturally, he is a bull. But it comes up next on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny in New York with Danny Berger in London. Hoisington's bullish stance on the U.S. bond market has come at a high cost over the last 3 years. But the longtime chief economist, Lacey Hunt, is confident that the recent retreat in Treasury yields will gain steam once the U.S. economy goes into, as he sees it, a hard landing. I spoke exclusively to him yesterday.
The cloud is breaking because the economy is heading into a hard landing. But it's a process that will take time. The U.S. economy has very serious difficulties. Difficulties are going to be with us for a long time in the future.
That hard landing, when we last caught up with you, if I look at M2, and I know that you're an advocate of ODL, other deposits and liabilities, but M2, according to the St. Louis Fed, is negative for the first time in nearly 70 years. Is that going to cause a much harder landing, perhaps, than the market presumes right now when you look at bond yields at 4.5%?
Well, several years ago, I rewrote Friedman's great paper to the American Economic Review on theory of interest rates. And Friedman said monetary decelerations lead to lower interest rates. I adjusted his theory to say that monetary decelerations lead to lower interest rates unless the velocity of money rises. And we have a very serious monetary contraction in real dollars, which is the way I prefer to look at it. If you look at my preferred measure, ODL, or it has declined in real terms over the last 12, 24, and 36-month intervals. And although velocity has risen slightly over the last 2 years, I believe the velocity is in the process of making a move to the lower side over the course of the next year. And this will greatly complicate the Fed's ability for monetary policy to work when they do decide to lower interest rates. There's an old phrase that when the Fed tries to stimulate, it's like pushing on a string. In this particular case, the pushing on the string will be even more difficult than normal for the Fed. The Fed's capabilities will be very asymmetric when they need the economy's support, which I suspect they are going to need quite significantly in the next couple of years.
I just want to understand, if we look at the curve, the position on the curve, assuming your duration-weighted yield position, is 18 years the optimal position, or do you think coming down the curve is where there may be a bigger yield uplift?
The yields will, what we're going to see, we're beginning to see it now, is the yield curve will normalize. The short yields will drop more rapidly than the long yields, but the greatest capital gains opportunities will be in the longer end of the curve.
Do you think more term premium? Do you see that expanding further? We've talked a lot about it in the past 3, 4, 5 weeks. There's been quite a move in term premium. Do you think that term premium increases from here?
I think the main thing that I would focus on is that we're going to see the degree of inflationary expectations fall very dramatically, and probably back to the levels that existed prior to the pandemic, somewhere in the 2% range, as opposed to being above 3 now. And I think when economic conditions weaken, investors will see that there is great advantage in holding the long duration treasuries. From my perspective, I don't think it's necessary for me to focus on the amount of cuts that the Federal Reserve will cut. They will cut the rate, but unfortunately, the net national saving will remain negative and a constraint on growth long after the Federal Reserve cuts the rates. Also, keep in mind that the rate cuts will be in the cyclical fashion. The economy will decline sector by sector, and as the Fed moves slowly, so will the economy. And I think that the Fed will remain behind the curve, just as they remained behind the inflationary curve in 2020 and 2021.
Hoisington's chief economist, Lacey Hunt, with me yesterday. Danny, look, it was very difficult to get Lacey to give us a level. He's naturally a bond bull. They've had a very, very tough time at Hoisington. The last time we caught up with him, of course, they had at one stage asked themselves the existential question, which was, did they need to reduce their exposure? He still stands by the 18-year duration, even though I was trying to push him to tell me, as many people have said, they like the belly of the curve. Everybody I talk to says 5-year and 7-year paper is where they want to be, but it's going to be a tough job for the Fed next year.
It does. And again, as you were saying, in what he said to you, Manus, his argument was that there's a hard landing to come. Deutsche Bank was talking about this idea that the market's making a 7th run at a dovish pivot, and each time it's ended in heartbreak. So it's in the past it hasn't worked so well, Manus.
Yeah, and of course, you know, we started the conversation. I said, did last week's data, last Friday's data, was it a break in the clouds for the bond bulls? And of course, he naturally acquiesced and agreed.
Yep. All right, Manus, coming up, we're going to have a look at some of the market-moving events to watch for you throughout the day on Bloomberg.
that's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London with Manish Krani in New York. Let's get you set up for your trading day with a look at what is ahead. Fed Chair Jerome Powell will be speaking at 9:15 a.m. Eastern. We're also going to hear from Williams, Barr, and Jefferson throughout the day. Plus, we're going to get earnings from Under Armour, Ralph Lauren, and Warner's Brothers before the open, then Disney and ARM after the market close. And Bloomberg's New Economy Forum is in full swing in Singapore. It's a great lineup for day two. That includes UBS CEO Sergio Armati, Citadel CEO Ken Griffin, and former U.S. Secretary of State Hillary Clinton. So a busy day, Manis, between the New Economy Forum, Fed speakers, and earnings.
Yeah, it's going to be interesting to hear from Marty as they are on that journey of transformation after they gave us their numbers yesterday on the 22 billion of inflows of money. Today it's all about Disney and ARM. They're going to report after the bell. So we're going to keep an eye on the streaming service. Will that return to subscriber growth? You saw the Netflix numbers, but that's idiosyncratic for them, isn't it? And then ARM. This is going to be their first results since the IPO. And I think, if we're not wrong, they closed at 55.27. That is above the IPO price, isn't it?
It is above their IPO price, but just barely. A lot of these big IPOs we've had, Manis, have dipped on, but it's true, they all have dipped under their IPO price at some point, be it Instacart or Birkenstock. They were supposed to be the things that revive the IPO market. Will they? And what will the earnings mean for, the excitement around these big IPOs?
Birkenstock's just waiting for you to come sit here beside me so you can get your duo Birkenstocks for next spring.
Yeah, I think I need them now. I think we've talked about it too much for me not to.
Yeah. Commerzbank, just check in. It's interesting. In the past hour, 56 minutes in, we've gone from hero to not zero, but down 4.28%, despite the 600 million buyback. It's a tough one. Bloomberg Brief is done. Surveillance is up next with a new theme tune right here on Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate.
That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
DOJ or other authorities.
We could face bigger challenges next.
Was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We are seeing some evidence that the economy is indeed slowing.
The Fed needs to be very, very cautious.
It's been impossible to project anything in this weird environment.
I think the Fed put is back. The economy is going to slow, but I think earnings are going to be resilient.
There's still really a good chance that we're going to see a lot of this volatility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P 500 slightly negative over the last week. Anything but. All about a rally. Tom Keene, 7-day winning streak on the S&P 500, 8 days on the NASDAQ. Over that period on the NASDAQ, we're higher by 8.4%.
It's a character of it. I noticed Microsoft yesterday out to a record high, I believe. Don't quote me on that, John. I was on sabbatical. But the basic idea here is Microsoft with leadership on AI, on tech. Up we go. It's tech. And, we had some great guests to talk about that, leading with Dean Kernan. But what I would suggest is Ben Laidler there. The bulls were lonely 6 weeks ago.
They're emboldened now.
The bulls were lonely. Binky Chada was talking to a crowd of 1.
I think when the people like Ben Laidler come out and start saying the Fed puts back, I think it's fair to say the bulls are feeling confident, Tom.
Yeah. John Stolfus was on. John Stolfus was like a piñata with a short crew, 6 weeks ago? We're 20 points SPX away from his target.
He's got company, that's for sure. Bramo, we've been asking the same question over the last 24 hours. Is the Fed going to spoil the party? Chairman Powell, a little bit later.
They're all trying to, sort of. They're sort of tiptoeing around. Well, we might have to do more. We heard that yesterday from a couple members, including Neil Kashkari. They haven't done enough, and the market isn't listening. And that was the clear takeaway yesterday when the more Fed official came out and said, you know what, we could do more. The market was like, I don't think so. But Chair Powell had a chance to do that last week, and he didn't.
They sound nervous, don't they? Governor Waller turning around and calling the bond market move an earthquake. They're still trying to understand. You heard that a lot in the Fed speak of the last couple of weeks.
Yeah, dark matter is all the things that we don't understand with respect to term premium. This is concerning because when you talk about the stock market rally, you think about what actually happened. All that happened was a rally in the bond market. This is not a stock-driven story. So at a certain point, no one seems to understand the move in the bond market, and no one can get very much conviction.
I think it's a stock-driven story. I'm with Ben Laidler on this. There's some earnings veracity to what's going on. Maybe on the revenue side, and maybe nominal GDP will come down and revenues will be a little lighter here. But let's remember that 6 weeks ago, 8 weeks ago, the street was extra gloomy. And that's when you move. And, John, that's the persistency we've seen here.
I disagree with you both.
That's
just to get the show started.
Yeah, okay. Well,
equity futures on the S&P, totally unchanged. What a run it's been in this equity market on the S&P 500 and the NASDAQ. The longest daily winning streaks in 2 years on the S&P 500. In the bond market, yields a little bit higher, up by 3 basis points. Lots of supply that Lisa can run you through in just a moment. Your 10-year Bramo, 459.36.
Yeah, we will get to that supply in just a second. You're talking about the Fed speak, and we're going to hear from Chair Powell, which is going to be basically a footnote because he's giving the introductory remarks at the Fed's Centennial Division of Research and Statistics Conference. He's going to also be speaking alongside Vice Chair for Supervision, Michael Barr. The lineup of Fed officials coming out every week, every day to speak is just getting longer and longer. We're also going to be hearing from Fed Vice Chair Philip Jefferson, Philadelphia Fed President Patrick Harker, and Michael Barr, Vice Chair for Supervision, all ahead of this, which to me, John, you are right to point to as possibly the key event of the day at a time where we do not understand what has been really whipsawing 10-year Treasury yields. We are going to get an auction, the first of real duration. The Treasury is selling $40 billion of 10-year notes today at 1 p.m. Do we see people come out? We did see people yesterday with a 3-year note. 10-year notes are different, though, and this, to me, is a huge test.
10-year, then 30-year. This piece of Bloomberg analysis in the last 24 hours, I strongly encourage you all to read. The estimated annualized interest payments on U.S. government debt has climbed past $1 trillion at the end of last month. Bramo, that's doubled in something like 19 months. It's unreal.
And you talk about why do people care? When are people going to wake up and start saying, how many bonds are the U.S. government going to sell? It starts now, given how much borrowing costs are rising.
Waiting for the White House press secretary, TK, just to open up the daily news briefing.
Yeah, Bramo, I
Quote
could
the
see
10-year.
doing that. It'd be great. You know, she could do the 10-year.
Bramo's going to do it for the White House.
Bramo could be White House press secretary. It'll be great. Olivier Blanchard published yesterday. It was a redo of my book of the summer, his magisterial book on the linkage of all this blather with our fiscal policy. And Blanchard's summary is simple. It's so screwed up, Europe more than us, that we're going to extend the x-axis out, and he used the dreaded D word, decade. This is a decade solution.
The other thing that's getting expensive are all the streaming networks that you're going to be buying, and that's been something that's been a theme throughout the year with all the price increases. We get more of that today with earnings from Warner Brothers before the bell. We get AMC after the bell with a real discussion around the Taylor Swift effect and how long that can last.
She's
and
seven
then
of
Disney.
the top 10 singles.
I know.
She's like the Beatles in 1964.
Oh.
But to me, I think you just absolutely crushed
I'm going
John.
on. What? No.
She has 7 of the top 10 singles.
Okay.
And Disney, too, is reporting.
All right, cool, great. Can we get to Dean? Let's do that. I think Dean Kerner joins us now, founder and CEO of Macro Risk Advisors. Taylor Swift better than no, just no. Let's talk about this rally. Rent it, don't own it. Dean, what does that mean?
Yeah, well, I guess Taylor Swift's equivalent in the stock market is the Magnificent Seven in the NASDAQ and the Triple Q. So a couple things happened last week that are pretty profound, and I just want to run with something Lisa said, which is the stock market rallied because the bond market rallied. And that's just not typical. There's been a reordering of the cause and effect, right? The history of duration as a stabilizer in a portfolio is that when the stock market gets into trouble and there's a nasty move lower in risk assets, the bond market rallies. So the bond market is a recipient of a flight to safety. Here, the bond market in some ways is the risk asset and the stock market is secondary. And set against the fiscal backdrop, I think it's altogether dangerous. I'm not inspired by the fiscal dynamics. You mentioned numbers like $1 trillion in interest expense, and that's only going up from here. So that's a risk. But in the near term, the short term, we have a reprieve. And, you know, we talk a lot about long and variable lags with respect to monetary policy. No one really knows what the impetus is for inflation going up or down. There's a lot of theories, but they're long and variable, these lags. With regard to financial conditions, that channel is short and precise. And all of these metrics that define financial conditions, they're all going the same way. So I'll give you an example. Interest rates come down a lot last week, so do credit spreads. That's also atypical. Those are goosing, you know, financial conditions. In some ways, it's good for the stock market short term. It's good for risk appetite. But it might complicate the Fed's process for trying to rein in inflation to the extent that inflation is a function of asset prices. They're all very correlated in a lot of ways.
Any reason to believe those correlations break the other way anytime soon?
I would have said that they would have by now. In other words, I would say that up at 5% on the short rate and a 5% 2-year note, you can argue that duration is going to play that role of stabilizer, that in a risk off, you're going to see a rally in the bond market. I do think that's going to return. Ultimately, we're going to see, and this is what we ended our conversation last time, Jonathan, with when I was on the program was 2-year notes, great place to hide out. Right, I felt good to be alongside Stanley Druckenmiller in that context. I think you've got a lot of ways to win. You're getting paid to wait, and you're getting paid a reasonable amount above inflation. But I think ultimately the response mechanism for yields, and I would put the back end in a little bit of a different category because of supply and because, frankly, of fiscal irresponsibility. But something like the 2 to 5 year part of the curve, that's a nice place to hold some capital, because I do think ultimately you'll rally on a risk off.
I got 3 standard deviations down to S&P 4,100 where we were a cup of coffee ago. We've come back halfway. We're barely back to halfway in terms of the volatility matrix out there. But within this, we're doing it in quiet. The quiet that's out there, which you highlight in your research note, is extraordinary. Does that mean a more short squeeze to come if we drive higher?
I would say not really. I don't think the market's super under-positioned, and I would say that implied volatility reflects that. You know, typically when you have a big short base, you might have something that indicates that the market's susceptible to a big pop higher. You can look underneath the surface of the implied volatility in options, and you can see that there's not this expectation of a large jump. Jonathan, you started with rent versus own. So, you know, in U.S. housing, renting is historically cheap versus buying. We know affordability metrics in housing are awful, just given prices and rates, that combination. In markets, the buy versus rent trade-off is also very favorable to the renter. And I like to call the option buyer a renter. I like to say that the renter doesn't pay for the plumbing problem. And so in markets, there are a lot of potential hiccups that can come, set against the VIX here that's down at 14. And I'd also point to a NASDAQ VIX that's at 18. That's really low. So you've got, for example, in the NASDAQ, a 30% move up in the stock market, in the market this year, and a really cheap cost of renting the market out to year end, set against pretty favorable seasonals as well. So I really like buying upside calls in either the S&P or the NASDAQ.
You said earlier the bond market is the risk asset, and this is highly unusual since this is usually the ballast. Does that mean that people are overly sanguine to the riskiness of stocks, or that stocks have gotten underpriced because people are so confused by the stabilizer being so volatile?
I mean, I think we can look at the stock market valuation metrics in a number of different ways. Versus earnings, you're kind of middle of the road in terms of PE multiples. Some might argue that your multiple rate adjusted is too high. And so as rates have come up, the multiple hasn't really suffered to the extent that people have thought it would. But ultimately, earnings are solid and stable. And I think as I step back and we go back to this term long and variable, I just don't think we've seen the impact of rates just yet. I think it's a 2024, maybe even to 2025 story. So I think the quiet in the market is a reflection of stability in the multiple and stability in profits. Ultimately, I think that gets dented, but it's a ways away.
In the next couple of days, we're going to have to start worrying about a government shutdown again, and I'm sure that we're going to hear a lot more, especially after the Republican primary debate later today. How do politics figure in, if at all, into what you're seeing in terms of volatility or how you're positioning?
Yeah, so shutdowns are not debt ceiling, date certain, you've got to get this done by a period of time. I do think the shutdown is just another indication of the fiscal issues on the left and the right and the inability to govern in a lot of ways. You know, the Fitch downgrade, I think, late summer was a function of not just the debt dynamics, but also just the ability to work proactively and effectively on behalf of the country. So I think it's just going to be another notch in this inability to work together set against just awful fiscal dynamics that aren't going away.
Dean, this was great. Really thoughtful stuff.
Thank you.
I'll go home later and re-listen to it all. Dean Koenig there of Macro Risk Advisors with some really important stuff there on the bond market. If we can get to crude, just get up the market board quickly and take a look at WTI. WTI crude is trading in the 70s. We're down again on a session. We just had the biggest one-day move lower in about a month yesterday in the oil market. 76.84 is the lowest since July. So here we are, Tom, in the 70s on WTI crude on the same day that Israel said its troops have entered the middle of Gaza's main city. This is not where we thought we'd be
exactly
a month ago.
Yeah, it's without question the great missed call here. I missed it as well. I was wrong on this, like everybody else. I don't know if 90 or 100 makes sense, but certainly to see 70 is a shock. And what I saw in my sabbatical that was so important, I'll be publishing on this, folks, a sabbatical. You'll look for that paper in January. But on the lengthy sabbatical I took, John, I would really suggest the whispers of deflation out there. Just to give you one idea to link into $70 West. What are you laughing at? West Texas Intermediate.
The sabbatical paper.
What I would
just the idea that people are going to start googling for this paper that's never come.
But within all the gloom that's out there and all this, how many Fed speakers do we have today?
A lot.
A lot. That's 8 too many. A lot. Guess what? Pork prices in China have collapsed. That's another example of a global deflation. Look at the different vectors of Germany. Another example of disinflation and deflation that's out there, and you see that within the shock of oil.
Is the price story getting better because the supply side's improving, or is demand rolling over? When it comes to crude, we're going to be talking more about demand, I think, Lisa, in the weeks to come.
Especially because the U.S. government put out a report yesterday saying that American gasoline demand will drop to a 20-year low next year. So just put that into some of the reasons that might be backing some of the move that we've seen.
Brent, 81, WTI in the 70s. Dean, good to catch up, as always. Next hour, Sebastian Page at T. Rowe Price is going to be joining us on this programme to break down a stunning rally. In the equity market, 7 days of gains on the S&P 500. Have we opened the door for a rally into year-end? From New York City this morning, good morning.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
I think that the House Republicans and the Senate in general are committed to the government not shutting down. For many reasons, I don't think it will. Or if it does, it'll, shut down for 8 hours or something like that. There is a commitment from both sides, from Speaker Johnson and from the Senate, not to have a government shutdown. How that works out, I can't tell you, but I do think that's a commitment.
It's a commitment. Senator Bill Cassidy of Louisiana speaking to our colleagues on Balance of Power in the last 24 hours. We need to talk about the next 24 hours. The amount of debt coming to market from the US Treasury. Lisa went through the 10-year notes that come a little bit later on this afternoon. $40 billion worth. Then on to tomorrow, $24 billion of 30-year notes. You put it all together. The interest cost in this country right now is coming from Bloomberg Analysis here in New York. The estimated annualized interest payments on the US government debt pile climbing past $1 trillion at the end of last month. Bramo, these are interest payments. I think we have to keep going back to that. We're talking about interest payments through $1 trillion potentially.
The deficit is manageable when interest rates are near zero. If you're not paying anything on this debt, you can have a massive debt pile. When interest rates start climbing, that same deficit becomes punitive to the level of 5, 6, 7, 8% of the GDP coming out 10, 20, 30 years. And this is what people are focused on. And people in Washington, I guess, have to realize this might be what's going on in the bond market.
It's a real world, and I take your point strongly that it's going to be a political football. I'm not saying people will vote on the debt or the deficit, but it's going to be discussed here as we see this higher interest rate. But I would run it up against the arch formula, R minus G, and that all of our interest rate analysis is predicated on America having buoyant growth, and that's a little bit shaky right now. That confidence is not quite
We
there.
certainly got that in 3Q. I think now we're looking for that to slow into 4Q and into next year as well. If you are just joining us, here are the scores in the bond market. The 10-year right now, yields aren't in the 5s anymore. That's the good news. Over the last couple of weeks, we're back down to the 4s, 458.73. We're up a couple of basis points on a session, though. In the equity market, what a run we've seen. 7 days of gains on the S&P 500, 8 days on the NASDAQ 100.
Let's review this. This is important.
Can you call it a melt-up, TK?
No, it's not a melt-up. It's a persistent bid. I've been watching it really carefully. I'm away. I'm on the sabbatical. We're trying to decide when to publish, and the answer is I'm watching this on an hourly basis, and the bid's there. It's not about a melt-up. It's this kind of thing. Pulls back, in they come, pulls back. It's a different feeling now, as Dean Kern had talked about.
The longest run against Tom in about 2 years, going back to November 2021, up by more than 8% in a week on the NASDAQ 100 is quite a run.
VIX 14.86 right now. Let's get to the political moment here. Look for balance of power tonight. Anne-Marie Horton and Joe Matthew on that. Jeanette Lowe joins now, Director of Policy Research at Strategas. It is a Baird company. Jeanette, these elections matter to me, and when I look at the governor of Kentucky, when he won Attorney General, he won by 2,000 votes in Kentucky. When he won the first time as governor, he won by all of 6,000 votes. There is the shock of Virginia. Was it a question of close votes, or did the Democrats win resoundingly?
Well, I think the Democrats had a really strong night last night. I think that in a lot of these cases, as you mentioned, Bashir in Kentucky won by only 0.4 percentage points in 2019. This time he has about a 6 percentage point lead going into his reelection. Yeah. So that is a strong validation for him being popular in the state, the Democrats being able to campaign on the correct issues this cycle. We saw that, Democrats did have momentum going into these midterm elections or off-year elections. They had won 24 of 30 special elections over the course of the year. And then last night with the elections that you saw in Kentucky, in Virginia, in New Jersey, in Pennsylvania, you showed that Democrats really did have some momentum on these down ballot races.
To borrow from the former president, so much losing. Will the Republicans change their approach?
I think that one thing is going to be difficult is that the one issue that has continued to be quite salient for the Democrats is the abortion issue. They used it in 2022. They used it this year. It's been a very good driving issue. You saw turnout in a number of these races, particularly the Ohio abortion measure that drove the election results. And so that is something that Democrats are going to be continuing to look forward to in 2024. You already had Sherrod Brown, who's up for re-election in Ohio, noting that he's probably going to be focusing on abortion in that race as well. And in Virginia, the Republicans tried to change the narrative a little bit on abortion. They tried to talk about a 15-week ban and said it was more of a limitation. It was more reasonable than what the Democrats are proposing, and voters rejected it. And so that is going to be very instructive going into 2024. Republicans are going to be struggling on this issue. They're going to have to figure out other issues that would be better positioned in order to get some votes and change some of these outcomes.
Jeanette, how do you understand the fact that Biden is losing in a lot of polls, particularly with the matchup with former President Trump, and yet the Democrats had a really good night last night?
So what it shows to us is that Biden is weak, but is more isolated to him. And so down ballot Democrats have been able to separate themselves. They've been able to show their own messages. And that's important in a lot of these races. And it's very important going into 2024. Now, obviously, having Biden at the top of the ticket will be important. We do still have a long way to go. Polls at this point are not necessarily very instructive to what we're going to see in November 2024. But it does show Democrats that they have an opportunity ability to separate themselves from Biden, to still go out on their own messaging and still be able to produce strong results. And I think that should give the party a little bit more comfort this morning as they're looking ahead to 2024.
It's coming amid a lot of discomfort, I should say, especially after the censure last night in Congress of Michigan Democrat Rashida Tlaib. This question around the fissures in the Democratic Party, do you think that they have been overplayed or underplayed heading into this election cycle?
So, I mean, this is going to be something that's going to continue to ramp up, this issue, particularly with the, support for the Middle East and how this gets done, whether we're trying to just support Israel or are we trying to really help Palestinians in Gaza. That's going to be an issue. But I think you also saw that in a lot of these races, it goes down to specific issues within that district. And there, people were thinking about whether New Jersey, whether Senator Menendez's indictment would have a negative impact on Democrats in that state. And it didn't. So a lot of these races, they are local. It's more focused on local issues. And so when we go into 2024, national issues will matter more. But I think you can see that Democrats are also able to reach their base. Right. And then it's going to be up to Republicans to also have a similar counter message.
Jenna, not to get the crystal ball out, but we do have a surveillance crystal ball out today. It's right here. It's putting off a nice glow here. On radio, it's a beautiful crystal ball we've got in front of us. Jeanette, I'm going to cut to the chase. The Republicans have to adapt. That's all there is to it. In the primaries, in the debates as well. What nuances will we see? What does a Haley do? What does a DeSantis do, et cetera?
Well, so I think one of the things that we'll be watching for tonight is, Nikki Haley has been getting some momentum, and now we have a lot of geopolitical issues that are at the surface. And so Nikki Haley is going to really try to capitalize on those issues and try to put herself above Ron DeSantis in that frame. So that's something where I think we're going to be really watching, because as we've seen over the past couple of months, that geopolitical issues are becoming increasingly important. Bread and butter issues are always going to be important in a presidential race, but these issues are going to be important going into 2024. We probably haven't even seen the extent of it yet. So the dynamic between someone who's very strong on national security versus someone who's stronger on domestic issues, I think that's going to be a big play in the debate tonight.
Jeanette Lowe, wonderful to get your thoughts as always. Jeanette Lowe there of Strategas, the third debate, I believe, for the presidential candidates for the Republican Party. A headline crossing the Bloomberg just moments ago. Let me share that headline with you. This is from the executive arm of the European Union, the European Commission, formally recommending opening membership talks with Ukraine. Several layers to this that are worth working through. The Commission's opinion needs to be approved by EU leaders at a summit that will take place next month, so in December. Alberto Nardelli here at Bloomberg does a wonderful job at breaking this down, so I suggest you go out there and read the story that he's just published. But Tom, ultimately, this can take a long, long time. So the last member of EU expansion was Croatia. That took 10 years. And if Ukraine wants to make this happen, they're going to have to go through a series of reforms. And Alberto lists some of them, and I can share some of them with you right now. They need to enact legislation on minorities, anti-corruption, to regulate lobbying, to bring it in line with European standards as part of this anti-oligarch push. Tom, this can take a long time.
It's going to take a long time. It's going to be step by step. But can you imagine the reaction at the Kremlin today?
To those kind of headlines?
Stunning.
This is the direction of travel. Let's put it that way. Coming up, Nick Benenbrook of Wells Fargo from New York City. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
7-day winning streak on the S&P 500. What a run. Best run of the year so far. In fact, you have to go back 2 years for a run better than this one on the S&P. Likewise on the NASDAQ. Futures look like this. Just about unchanged on the S&P 500. On the NASDAQ 100, unchanged as well. On the NASDAQ, though, over the previous 8 days, 8 days of gains. We're talking about a gain of 8.4%. Led by tech, obviously, helped by this in the bond market. 2-year, 10-year, 30-year. The high of the cycle of the year on a 2-year was 525, call it 526. That was the middle of October. Go back to the high on a 10-year, that was just north of 5%. And these are the levels we've come back to. 493 on a 2-year, on a 10-year, back to about 457. And Tom, that move has supported this equity market.
It has. There's no question about it. The bonds are linked into the equities as well, but there's something else going on. There's again, when you look at the equity bid that's out there, and I'm going to just go out, John, to the wall of money that's out there and how many people were on the sidelines, that's overlaid into the bond rally we've seen.
The trillions of dollars in money market funds. Lisa, sitting there. Rick Reeder of BlackRock started to talk about this on Friday, and I started to think about it over the weekend. What would it take to unlock all that cash to get people to start distributing it back, allocating it to the equity market again?
You know what I saw recently? A lot of people talking about dividends and saying, well, how much are these companies actually paying out? And the fact that they're doing that makes me think it might take a while. Because right now, if you're keeping your money in cash, you're getting a 5% yield. If you're looking at stocks as a dividend play again, they have a long way with earnings per share as well as with the actual dividend payments to catch up with where bonds are.
You want to talk about the surprise of the last month? I keep going back to the same place. It's in the commodity market. It's crude. We've just had the biggest one-day loss on crude going back to the start of October. We're in the 70s on WTI.
Look at follow through.
The lowest since July, Tom. The lowest since July, even with the heightened tensions in the Middle East.
No, this is the global demand story. It's just all there is to it. And we're going to talk. We've got a wonderful guest coming up, John, to really nail this down.
Let's start there. Under surveillance this morning. Israel is saying its troops have entered the, quote, heart of Gaza City as it continues its operation against Hamas. Prime Minister Benjamin Netanyahu saying there'd be no ceasefire until the roughly 240 hostages are freed. G7 foreign ministers releasing a joint statement calling for humanitarian pauses in the conflict. Biden urging Netanyahu to agree to a 3-day pause, according to Axios. Tom, Lisa and I were talking about this yesterday. The pressure that's ramping up on this president here in America to ramp up the pressure on the leadership in Israel to conduct some kind of what they're calling humanitarian pauses is just getting higher and higher.
It's like every other war, except this is the first war with this immediacy. It's amazing to line up 6 newspapers, 6 websites, and see the immediacy of the transfer of information. It's just, this is absolutely original.
And I think a lot of leaders are trying to figure out how to work with that because that flow of information is very much affecting some of the protests to the people who are coming out. So You have leaders like Saudi Arabia coming out and saying, hey, Biden, hey, Israel, we have a problem because our people are getting outraged and we are running out of time, even though Saudi Arabia hasn't taken the idea of normalizing relations with Israel completely off the table.
By no means am I an expert at this, but the animosity, I'll call it, of the various Arab League nations against select parts of the Palestine community is evident. I mean, that's one of the complexities beneath the headlines.
That pressure is domestic as well, Tom.
Yeah.
Could well become a campaign issue going into next year as well, an election issue. Speaking of elections, local elections, Virginia Democrats winning majorities in the state's 2 legislative chambers, ending Governor Glenn Youngkin's efforts to unify GOP control in the state and dealing a blow to his possible presidential bid. This was one of the number of wins for Democrats as voters in Ohio endorsed abortion protections, while the Democratic governor of Kentucky also won re-election. Bramo, we were talking about Governor Youngkin jumping in. Governor Youngkin himself wasn't talking about that, but ultimately you'd have to say, at least this morning, off the table.
So 2 things. Does this take Glenn Youngkin off the table, not only for this cycle, but also for 2028, right? That's number 1. And number 2, does that put Nikki Haley very much in the front-runner seat to possibly counter the former President Trump? And the debate that we get tonight at 8 p.m. in Miami might shed some light on that at a time when maybe the election results that we got last night are not indicative as much of the national mood.
But off the radar, does a 45-year-old in Kentucky join the Democratic debate for 2024? Maybe not. I believe we have a sitting president. But 2028, and this is Governor Bashar winning nicely in Kentucky, a lonely Democrat.
We do have a sitting president, but we're still talking about the prospect of that sitting president dropping out of the race for a second term. That conversation's going nowhere. This story caught my eye this morning. Chinese President Xi Jinping set to be the guest of honor at a dinner with U.S. business executives when he visits San Francisco for the APEC summit next week. Bloomberg reporting hundreds of people will be in attendance at the dinner, including CEOs of major U.S. companies. While China is yet to confirm Xi's attendance at APEC, the White House has already said the Chinese leader will meet with President Biden at the summit. I just want to try and frame this. I cannot think of a bigger spread between the mood of the country, the position of Congress, and then corporate America, which is somewhere over here when it comes to relations with China.
Yeah, I don't disagree at all. Just in the last 48 hours, we've had CEOs wandering off to the Asian Rim to keep the dialogue going. Are they our diplomats? That's a debatable question.
They're their own diplomats, and they're all their own diplomats. And here's my question. How much does Xi Jinping need them? And how much can he actually promise them stability at a time where the rules are changing and there isn't necessarily some concrete feel that they're not going to be upended with something, right? How much is this him courting them rather than them courting him? It is a two-way street at a time where that economy is seeing a decline in foreign direct investment for the first time ever in data going back decades.
I think you might be able to go a little bit further. I think some people might describe some of these business executives as diplomats for China and not diplomats for what's happening in the United States of America.
Well, I think that some people would push back.
And I stress, some people. Yes. I'm not suggesting that, TK, you want to save this?
I'm going to save it right now. Everybody listen, and particularly Global Wall Street, listen right now. He is too not modest to mention it. There's a single line in his biography at Wells Fargo of a tour of duty at Brown Brothers Harriman. He won Currency Forecaster of the Year 2 years in a row. That is unheard of. Nick Benenberg joins us now, international economist at Wells Fargo. Thunderstruck. I got all sorts of currency questions, but we don't have time for that. You have a single sentence in your report of global GDP of 2.4%. In my textbook, that's a recession. Are we in a global economic recession?
No, I don't think it's the recession. It's a downturn. It's a slowdown. But actually, I think one of the previous times I spoke to you, I was mentioning 1.6%. So I've actually gotten a little more optimistic, Tom. It's going to be slower, but I don't think we're about to go into global recession.
Okay, 2.4% is not a global recession, but the IMF has it out to 2028. Do you see where this works out, and with your expertise from New Zealand, that it works out across the Pacific Rim to a new buoyancy? Do you have a recovery in mind?
We do, although to be fair, I think when we look at sort of long-term trends, we're probably thinking about 3% global GDP growth as opposed to 3.5%. And I think one of the reasons for that is China, for example. There's been a lot of policy stimulus this year. They still have demographic issues. They still have property issues. And so I think we need to become accustomed to a slower trend for the Chinese economy, and so a slower trend for global growth overall, even beyond this downturn that we're going through.
Before we move on, just to have you weigh in a little bit on the discussion we were having of Xi Jinping meeting with hundreds of business executives in the U.S. in San Francisco at the meeting coming later this month. Do you think that this is China realizing that it's losing foreigners, it's losing the room, and it needs those businesses to not see even slower growth and a more difficult situation?
I think that's probably correct. I mean, obviously, I wouldn't want to speak for the Chinese government or try and understand their motivations. But what we're seeing, for example, is greater fragmentation across the global economy, and some of those trade linkages, starting to fragment. And also, I think that there's some hesitation in terms of just the large-scale domestic stimulus or fiscal stimulus in China itself. And so if you can sort of utilize the global market to a more of an extent, I think that's a way to address the slowdown that's taking place.
There's been a lot of debate around the oil price that we've seen, and we were talking about this earlier, that prices have fallen even though everyone expected them to rise in the face of geopolitical uncertainty. Is this a demand story that people are underappreciating that suggests some sort of slowdown on a global level that has not been fully priced in?
I think that's probably true. Certainly, the slowdown is taking place here in the United States, but it's a gradual affair. It's, 150,000 in the payrolls last month. But when we look around the global economy in Europe, we think UK is probably going to fall into recession, and Eurozone, if anything, will just narrowly avoid it. You really have to look far and wide to see areas where there's a lot of positivity. And so, yes, I think that 2.4% that Tom cited, that slowdown's coming through, and so in that sense, it's understandable that we're seeing this decline in oil and commodity prices.
I can't fathom the value add at Wells Fargo, having you as an international economist with your foreign exchange team, which is also noted as well. What is the Wells Fargo call? What is the Embark call on dollar resiliency?
Well, for now, we think, as I mentioned, that slowdown's taking place, but it's really hitting hard in Europe right now. And even Canada, for example, we're seeing a downturn in businesses there as well. So, I think that downturn's going to come a little later in the United States. In terms of relative performance, the US does well for a little while. The dollar, I think, can gain against the euro, against the pound, and against the Canadian dollar, probably 2, 3, 4% through until the early to middle part of 2024.
Neil Kashkari, the Minneapolis Fed president, was on yesterday, and he's watching the dollar as well. And he said the reason why he rejects ideas that the yield on U.S. Treasuries in the long end have risen as fast as they have is because of the fiscal picture. He said the reason why that's not really what's going on is because take a look at the dollar. The dollar should be weak. Do you buy that argument, or do you think that on a relative sphere, all developed markets are facing the same problem, which is interest payments going up and deficits that are not going down?
I mean, I do think most governments are facing, challenges now in terms of, elevated debt levels. Japan's a notable example, and they're clearly dealing with their exit from yield curve control. So yeah, I think it's an issue that's pretty fair across most countries. Also, I would suspect that these debt issues, they do come slowly. As we heard before, the voters aren't going to vote on debt or the deficit itself. So for right now, in terms of the day-to-day in terms of the day-to-day of the foreign exchange market, we're probably looking at relative growth as opposed to that longer-term deficit issue.
We've got to look at the math, and of course, with Nick Benenbrook, you've always got to look for the probabilities. John, we've got to go to Professor Winchester at the Auckland University of Technology, who is the world's expert on rugby probabilities.
Oh, here we go. Now I know where we're going.
Nailed that the All Blacks finally, without Dan Carter, would be at risk. And that's what you and I observed the other day with Nick Benenbrook.
Nick, would you like a word on your World Cup loss in the last couple of weekends?
I think the less said the better, but thank you for mentioning that, Tom.
TK, why did you go there?
I want to go there because I thoroughly enjoyed it, and I had no clue what I was watching. Should they have beaten South Africa?
I feel like that's every segment, Bramo, isn't it?
Yeah, it is true.
It was fantastic. I just had no clue.
Were you watching this incredible match in France and the emotion of it, knowing that they should have beat South Africa?
Maybe I can come on again in 4 years' time when the next final is on. But it was a lot of fun, and it was a great.
To be as dominant as they were for most of the final, Tom, one man down through most of the game. It was pretty incredible. And you mentioned Dan Carter. For people who don't know, Dan Carter was basically the greatest fly half ever. He used to play for New Zealand. He was the guy that took the kicks. And I would say the All Blacks missed, was it 2 kicks? 2 kicks in that game?
They did. I remember those. I remember both of those misses. Yes, I do.
You're never
I think if Dan Carter was there, you'd have to imagine at least one of them go in and then it's a different result.
Should he retire? He's 41 years old. Did he have to retire?
Maybe I can get out there and have a kick. I might have done just as well.
Okay.
Phenomenal effort. Good to see you, Nick. Thank you, sir. Nick Benenbrook there of Wells Fargo. Squeeze needs some rugby here, TK.
Well,
nice.
Guy Johnson
would be so
called
proud.
me up, and Guy just said, you've got to talk to Benenbrook about, New Zealand and the All Blacks. They never lost when I was younger. Like, they literally never
One thing
lost.
that stands out for me, and I know you and I talked about this a little bit earlier this week, the respect that rugby players have for match officials, for the referees, is phenomenal. They make a decision. They make a decision. That's the decision. You walk away. There's hardly any back chat. Maybe the captain goes over and has a conversation. There's full transparency. That's it. And they make mistakes. They make mistakes, but still, you walk away. European international football right now, Tom, club level football, particularly in the Premier League, is absolutely dreadful.
It's out of control.
The attitude to the referees, I would go with you. It's out of control.
It was good to see AC Milan take the trophy last night against PSG, because I didn't see much back talk against the refs. It was different than the Premier League.
We actually won a game, Tom. That was nice.
Yes, it was nice.
Thanks for that. Thanks for tuning in. Dan Ives of Wedbush coming up shortly on this massive tech rally. Why Dan Ives thinks this rally can continue after a big move over the last week. From New York City this morning, good morning.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees, I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard, and if you don't give up, hopefully you find a way.
We look at the broader tech complex. We do think that the outlook has improved, even though we do remain, neutral on the sector. We do think that there are pockets of opportunities. We do think that the growth complex still remains intact, even though you might have some outliers in some of the larger names, like particularly in the smartphone and hardware area.
Nadia Lovell of UBS on the latest equity market move, the latest equity market call over at UBS. I have to say this morning, was going through the Southside research, I was so happy to see Jonathan Gollop, Patrick Palfrey publishing for UBS over from Credit Suisse, Tom. Just fantastic to see.
It's a big deal.
I'll share some of the research with you. It's worth a read. This is their view now. Expect the S&P 500 to end 2024 around 4,600, implying an upside of only about 5% from here into year end. They're seeing weaker growth hurting revenues. Tom, that's the call from the team over at UBS at the moment.
Well, it's called, what they're looking at here. But I just think there's a lot of ambivalence in this quarter, and the guidance for it is as mysterious as the economic growth. Who's got a Q1, Q2 view?
It's got a 24 view.
What are you writing in your outlook after being that, all of us, including me, that wrong 13 months ago?
Those outlooks need to be published in the next couple of weeks, and I think that's going to be tremendously difficult to stick by those calls deep into next year. The call from UBS here, Bramo, sticky wages, deteriorating pricing power, rising interest expenses, ultimately weighing on earnings going into year end and beyond.
Yeah, although one area has been immune to anything weighing on earnings, and that's been the tech story, and not just any tech. And this is really my question. How much is the success of some of the biggest tech behemoths at the expense of some of the other tech companies? And I think about startups and smaller tier companies that don't have the economies of scale.
They also say a steep acceleration in tech earnings, so worth pointing out that bullet point in the note, Tom, contributing 2 to 3% to S&P 500 earnings next year.
We'll have to see. With a VIX at 14.84, that is Dan Ives' market. He is senior equity research analyst at Wedbush. He refuses to talk to us when Apple earnings come out. We only get him to pick up the debris. And we can tell, for those of you on radio, you can understand he's long Lily Pulitzer as well this morning. Great look, Dan. I want to talk about your 240 call on Apple. You're not lonely. There's a few other people out there with Dan Ives' optimism on Apple. When I saw those margins in a company managing for profit, not revenue growth, can you raise your 240 estimate?
Yeah, look, I think this is just the beginning of the next phase of the Apple story. You look at margins that are historical. You look what's happened on services now, mid-teen growth, and iPhones, despite the haters continuing to hate, is growing. Even when you take out currency and you look, it's even growing more. ASPs, the China iPhone demise story is a fictional Netflix story. And in my opinion, this is just the start of what I ultimately view as a $3.5 to $4 trillion market.
It's a slow day. We got to make some news here. Can you pop from 240 up to 250 this morning for us?
Look, I believe the best case or the bull case is probably closer to 275 as this all plays out. Because also now you don't have AI in those numbers. This is just the get out the popcorn moment for when Apple ultimately, I believe, over the next year introduces the AI App Store, and that's just going to be, ultimately from a services perspective, that could be an incremental 5, 10, 15 billion a year.
You made a couple of statements, so let's drill down on them. We can do that. We're friends. You talked about growth of the iPhone. What growth are you talking about?
So if you look at unit growth, units are growing into the December quarter. You also, if you take out currency, which is a headwind, you have basically mid-single-digit growth.
7%.
7%.
But you've been talking about a massive boom of people upgrading. I guess my question to you, Dan, to be polite about it, have you been right for the wrong reasons on the stock?
Sure.
Would you acknowledge that?
I would say that ultimately, if you look at this, what I view as a mini super cycle, that's playing out. The ASP story's played out, and I think our biggest call has been China. Despite many yelling fire in a crowded theater, the China growth is actually increasing, not decreasing.
But they had a down quarter, right, in China?
Well, if you look at China, mainland China was actually a record for the September quarter. When you look at the overall, as Keen talks about the initial reaction after,
sure,
iPads, Macs, that and $3 get you a cup of coffee. I'm focused on iPhones where units were up in China.
What I'm struggling with, though, and you'll appreciate this, if you came on today and say margins are better, they are. I'm with you. Okay, margins are great. Service revenue is where the growth is. That deserves a higher multiple. I understand that. Maybe you can make the case for why the stock is higher this year based on those things. When you say things like iPhone super cycles, when we've had no growth for 4 quarters in the company, that's where I struggle. Can you help me understand that?
So let's dissect that a little. First, when you think about the call it 500-600 bips FX headwinds, that is actually underlying growth that you're seeing in iPhone units, just to steady state it. I also believe our whole view of the iPhone cycle is really going to be over the next 3, 4, 5 quarters. That's where you're going to have these upgrades that actually come through. I'm not saying that you don't have some maybe minor share losses on the sort of mid-tier, but in terms of high-end, as a utility, this essentially is going to be a mid to high single-digit growth on iPhone. And when you start to run that through, that could be an incremental $1, $2, $3 of earnings as you look out the next 2-3 years.
There's a lot of growth already baked into valuation, and a big piece of valuation is where the buyers are going to come from. And you've been traveling around the world trying to hold everyone's hand and convince them that there is still value in big tech. How much do the losses of other areas of the tech-like sphere, and I'm thinking of Masayoshi Son and the more than $11 billion loss on WeWork, how much does that play into a little ambivalence about buying the story right now?
Look, I think you're definitely having winners and losers in terms of this just broader economy. And I think in terms of the Magnificent Seven, in terms of big tech, I think the strong get stronger. But Lisa, to my point, being in Asia for a few weeks and in Europe, it's very easy to sit there here in New York on your 10th floor spreadsheet being negative on Apple. What I see out in the world is a much different environment in terms of the growth that's happening. And I believe tech, to your point, you're going to see the strong continuing to dominate. And I think in terms of AI, we are just in the early stages of monetization. I think that's a big thing in this tech bull market. Microsoft saw it in terms of AI. You're starting to now see monetization. Datadog, that's a Hall of Fame quarter in terms of what we saw there. Palantir.